Start looking at those shares that we had on stocks to watch a moment ago, and the surprising one's probably Sainsbury's, that one dropping around 2%. Not 100% what the analysts don't like on that one. Perhaps it's the weaker than expected Argos sales, or maybe the fact that they've only reiterated their profit target for the full year. Some of them maybe expected a bit of an upgrade there. That one is declining on the FTSE 100. Meanwhile, also on that index, the home builders dropping after this downgrade from JP Morgan for Persimmon. They've cut that stock after 3 years, recommending clients buy, saying the valuation is too high and sales rates are starting to come down. Taylor Wimpey goes on negative catalyst watch at the bank as well. That one getting hit too. The biggest mover over in France, meanwhile, is Virbac. This is the animal care maker in the healthcare space. That one dropping around 12%, was briefly halted over in Paris due to volatility, but it is down sharply this morning. Going to bring up a couple of other stocks that we had our eyes on at the open as well. One of them is a company called Restore. Now that one dropping 26% in London. It's a mid-cap construction services firm. They've put out a profit warning. Part of that is based on, interestingly, the price of shredded paper, which they say is something that they use to put into their materials, and that is really hurting their income at the moment. That one's the worst performer in London today. Meanwhile, over in Amsterdam, we've got Flow Traders. Now, this is an ETF trading company. They've seen a slowdown in volumes. What's that saying about the broader financial markets? Are people pulling funds out of ETFs given the uncertainty? Perhaps that's what's hitting that one. We've also brought up AstraZeneca once again, an 8% drop yesterday, down another 0.7% today. Deutsche Bank downgrading that stock to hold, saying there's too much uncertainty after this cancer drug data yesterday. That one declining again on the UK market today.
Yeah, really interesting. I mean, the price of shredded paper on Restore, that is a new one on me, Joe. Thank you very much. Really interesting to see why Sainsbury's trading down. As you point out, Joe, not very obvious. Shore Capital, for example, calling this trading update very strong, positive grocery sales volume, and talking about their capital discipline. So we'll keep looking at some of the detail there. Coming up on the programme, we'll get back to the macro trends. Mark Dowding joins us of Blue Bay Asset Management. He'll be talking to us about his outlook for the markets and lags in monetary policy. This is Bloomberg.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. You know, I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that, you know, peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means, you know, for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, you know, it's very different, and it's not something people have had to operate in for a long time.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Markets Today, 14 minutes into the European trading session today, and we have European equity markets not going anywhere in a hurry. This Tuesday morning, it is the 4th of July. We're without the US. Probably we'll see lower volumes than we normally do across European equity markets because it's Independence Day, and so we bear that in mind, of course. We're just getting some breaking news coming through on Meta, losing its EU court fight over a German ruling on Facebook. And going into this particular court hearing, some of our colleagues suggesting, this is not necessarily the straw that breaks the camel's back in terms of the Meta business model in Europe, but it is a straw, and so something worth watching for the moment. We'll keep an eye on Meta ahead of the open, and we'll keep an eye out for more detail on this story, of course.
If there isn't a lot of interest in the equity markets this morning, there's a little bit more interest when it comes to the bond markets, arguably. If you just look at the sell-off that we're seeing in gilts, 2 yields, 3 basis points on the 2-year, 536. In terms of Italy as well, just debt there on the 10-year, ticking up in terms of the yields by about 4 basis points at 417 on Italian BTPs. When it comes to the bond market outlook then, Morgan Stanley versus Bill Dudley is how the contest is squaring up when it comes at least to the US bond market. In their latest assessment, the US Bank is challenging the former head of New York Fed and his view that losses are likely to deepen. Morgan Stanley essentially saying the sell-off in US Treasuries, particularly at the long end, is looking a little overdone. Let's bring in Mark Dowdin then, someone who has the finger firmly on the pulse of these bond markets, CIO of RBC Blue Bay Asset Management. Mark, where do you stand on this debate? Are Morgan Stanley right that the sell-off has been overdone?
So if we think about the bond market this year, if you look at the long end, the 10-year part of the curve, you're pretty much where you were at the 31st of December. So actually you could say yields haven't moved very much since the start of the year. Where, of course, there's been much more of a sell-off is at the front end of the curve, and that's been led very much by monetary policy, with the Fed taking rates higher, with the ECB also taking rates higher. I think the thing that I would say here is that we have reached a point where, in our estimation, you've priced enough in terms of interest rates at this particular point. It seems some of the earlier bullishness that the market had embedded in terms of looking for early rate cuts has kind of gone away now. And so we'd actually looking at the bond market now as pretty fairly valued. And at this sort of midpoint of the year, and you say, what's the next sort of big trade around the corner? I think I'm coming more around to the camp that actually the next trade is more likely to be lower in yields rather than higher in yields.
Okay, so that's your call, lower in yields rather than higher. If we take a step back and think about the inflation fight, Mark, what's your assessment of the transmission mechanism and how it's working? Is the fact we've seen headline inflation, it has been coming down globally, but core inflation has remained pretty sticky. Do we ask questions about transmission, or is it a question of timing? Are we just seeing longer lags this time around?
Yeah, well, firstly, I'd say that inflation is starting to come down, and I do think we are going to see inflation moving lower through the course of the next several months. We've got energy prices coming down, food inflation coming off the boil, as we've seen from comments from Sainsbury's today. But I think the other really relevant thing that we'd emphasize here is in this particular cycle, we've seen very long lags on monetary policy. I think the thing that has surprised a lot of the macro community the most, if we review the year to date, has actually been how strong, how resilient economic growth has been in many economies since the start of the year. We'd expected the monetary hikes that we'd seen already to start to bite and actually take away from growth, but there hasn't been a lot of evidence of that. But rather than saying that we think that sort of monetary transmission is broken and interest rates aren't working at all, we just think they're working with more lags. And this is partly a function of rates having come firstly from a very low level. Secondly, it's down to the fact that many participants have actually hedged themselves against higher rates by fixing their borrowing costs. But this is pain deferred, it's not pain gone away. I think the other thing we'd also speak to as well is non-linearities in monetary policy. That is to say that the further above the neutral rate you get, the more we think that monetary policy action will tend to bite. Whereas when rates are ultra low, in the same way as cutting rates is like pushing on a string, the early rate hikes that we saw did very little at all to really restrain growth. So we do think that more monetary tightening is very much in the pipes. And even if the Fed and the ECB do nothing now going forwards, we do expect the past effects of policy tightening to actually feed through and actually slow growth over the course of the next 6 months to 12 months.
Mark, that's interesting, and you've been prescient in terms of your calls on US Treasuries. So you know, worth noting your views that yields are going to come down lower. Do you regret your short on JGBs though?
Well, that's one that I think we can be patient with. Being short JGBs made us good money in 2022, and we were happy to book some profits at the end of that year. Since the start of this year, it's been a frustrating trade. We've actually seen sort of Japanese yields move somewhat lower. But I'd highlight here that we've seen core inflation in Japan above the 2% target now for 15 months in a row. We also see a situation where the more we see divergence between Japan rates and rates in other developed economies, this is undermining the yen. And so the longer that the BOJ actually waits to normalize policy, the more we actually think this is running a risk of turning into a policy mistake out of the BOJ, and ultimately it might actually presage a more radical a need to tighten monetary policy more quickly than they may want to when they actually need to get going. So we have another monetary policy meeting later this month. At the moment, there's very little probability being priced, but we think the message here is be patient on the Japan trade. It's a question of when, not if, yields move higher in Japan. So we'll stick with it.
So no regrets, but just patience. What about what you're seeing from credit investors? You talked about how this is pain deferred. What we've seen with the long lag in monetary policy markets, pain deferred, not pain gone away. So what does that do to default rates in credit markets?
So look, as the economy slows and we move towards a recession, we do fully expect to see default rates to move higher. I think that credit investors expect that from defaults at very low levels. But all of that said, if we're looking at a relatively mild recession, given that balance sheets have been in a relatively strong position, we're not particularly concerned in terms of how this is going to impact credit in investment grade. Even in the high yield bond market, because actually the need to finance a lot of debt is quite low, we think that high yield bonds can continue to trade okay, and so we're not far from fair value with high yield offering a yield of 8.5%. There are other parts of the credit market, however, where we do think you'll see more of those defaults, more of those issues show up. The bank loan market is one of those parts of the credit market, but we'd also be pointing to private credit markets as well. We think this is going to be where the pain is. This is where investors should be avoiding. Whereas there's other bits of the credit market, and we've highlighted bank credit as actually an area where banks are doing very well in the current operating environment that we think is cheap.
Okay, thank you very much, Mark. Thanks for joining us. Mark Dowding, the CIO of RBC Blue Bay Asset Management. We thank you for your time this morning. Coming up, tech standoff. China ramps up the row with the United States over chip technology. We'll bring you the story next. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Mars studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
This is Markets Today, 8:25 in London, 9:25 in Paris or Berlin. Wherever you are, you're not seeing much movement on the overall markets level for these European equity markets. Pretty flat this morning. It is the 4th of July, Independence Day, so we're without the US, of course. Tom, you've been focused a little on what's been going on with oil prices.
Does it smack of desperation? I don't know, that remains a debate, doesn't it, in terms of what's happening from Saudi Arabia and Russia, OPEC plus allies, of course, cutting their output. It's not a big surprise that Saudi Arabia has extended its cuts of about 1 million barrels per day into August, but it was Russia that came through with their, what, 500,000 barrels per day cut yesterday. Algeria as well, reducing output. So it's given a little bit of uplift to the oil price, $75 on Brent, 70 on WTI. Of course, the key question is it going to offset the lacking or lagging demand, particularly out of countries like China?
Yeah, absolutely. And one of our colleagues pointing out that every time we get these commitments to pull back on production, that it has a sort of, there's a diminishing returns in terms of the impact it has on oil markets. So yesterday we spiked up on Brent to, 76, then back down to 75 within hours. So it has some very short-term impact.
And real impact on the budgets as well of Saudi Arabia, because they're not getting the higher prices and they're producing and selling fewer barrels of oil as well. So that's a picture across the oil markets and the oil majors there. You can see Shell just up 0.3% on the back of that. Total over in France up 0.5. Coming up, we're going to be joined by Vince Cable, former UK Business Secretary, on the question of Thames Water, the political fallout, the role of private equity and the role of private capital in UK utilities. That is coming up, as is a conversation with the chairman of BNP Paribas. This is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Markets Today, 30 minutes into your European trading day. Here are your top stories. The RBA holds rates but warns further tightening may be needed amid continued inflation pressures and recession risks. China ups the ante in trade tensions, imposing restrictions on 2 metals critical for chip manufacturing, hitting back at US and European export curbs. Plus, crude rises after Saudi and Russia announced an extension to oil supply cuts a day before producers are set to meet at OPEC. So that's what we've got going on in terms of, the oil news, the oil market keeping us on our toes, essentially, with news out of Saudi Arabia and Russia in the last 24 hours or so. Plenty of geopolitics, the relationship between China and the US in focus, even though it is Independence Day, and we don't have US players in the market.
Yeah, those additional measures coming through from both China and the US, according to reporting from the Wall Street Journal around cloud services. And as you say, a couple of factors playing in, but really there's a little bit more action across the bond markets and the energy markets, the oil markets, than there is in these equity markets, because you're getting gains of just 0.1%. There's a bit of a sense of a pause coming through from these stock markets after, of course, the run-up that we've seen year to date. And the fact, of course, the US is celebrating Independence Day today. Over in Germany, the DAX flat, the FTSE 100 just unchanged as well, but holding above that 7,526 level. Interesting to hear from our guest at the top of the 7 hour saying that maybe the second half is looking a little bit more favourable for the FTSE 100 because of the dividend play and the cash return play from that index, which has underperformed some of the other major indexes year to date. In terms of your sectors then, I touched on energy. Basic resources, you're looking at iron ore and copper picking up a little bit. So let's switch it on and see how things are percolating through these sectors. On a corporate story here in the UK, Sainsbury's just outlining some of the cost pressures that are filtering through for that company as well. So one of the corporate stories. Across your sectors then, a little bit of move in autos, just up 0.1%. Travel and leisure picking up and gains there of 0.5. Banks also doing relatively well, gains of 0.3% there. Financial services in similar territory. I wanted to get to energy because of the cuts around Russia and Saudi Arabia, just up 0.1%. And again, it really points to the kind of muted upside that you've seen for Brent and WTI on the back of those oil production cuts from those 2 OPEC Plus members. Basic resources is actually down by 0.6%, despite the fact that iron ore and copper is getting a bit of a lift this morning. Anna.
Okay, Tom, we will take a short break. Coming up, we will speak to the BNP Paribas chairman, Jean Lemierre, joins us from Paris. Don't miss that exclusive conversation. Paris playing host to the Euroclass Finance Forum. Lots to talk about when it comes to that cross-channel rivalry in the financial services sector, but also the recent violence we've seen across France. How much does that weigh on the thinking of participants at this year's summit? This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Markets Today, 35 minutes past 8 here in London, 35 minutes past 9 in Paris or Berlin. The European equities session, fairly lackluster, certainly over in Germany. A little bit of upside coming through on the French market this morning, up 0.1% or so. And with that in mind, let's go to Paris. BNP Paribas has surpassed Goldman Sachs to become the top underwriter of high-yield bonds in the EMEA region. According to data compiled by Bloomberg, issuers sold nearly 42 billion euros of bonds in June as the value of deals rose 54% year-to-date compared to the same period last year. I'm pleased to say that we're joined now by the BNP Paribas chairman, Jean Lemierre, who is in Paris. He's there because Europlast is hosting a financial forum today, and he's participating in that. Monsieur Lemierre, thank you very much for coming to join us today. I wanted to start by getting your assessments of the French economy and the inflation fight. What work still to do?
Well, the French economy knows the challenges of all the European economies. We have challenges about inflation, we have challenges about energy policy. That's very well known, it's being addressed. Now, the French economy does well. Inflation rate is lower than elsewhere. The job market is good. We have never had such a low rate of unemployment. And business people are positive and constructive. When I speak to clients, they have in mind investing, notably in energy transition. They do their job, and I hope it continues like this.
Monsieur Lemierre, it's interesting, and you're giving a relatively upbeat picture of the French economy. Does that suggest you think that France avoids a recession? And of course, there's a debate in terms of the lag when it comes to monetary policy. Do you have clarity? Do you have a clean view on how and when the full effects of monetary policy will come to play?
That we don't know, and I'll be very careful of making such an assessment. I think we need to go back to basics. Inflation is still there, even if it is declining in some countries. But nevertheless, we see pressures. And we welcome the policy of the ECB fighting against inflation. This is what they should do, and they do it. And I think the comments made by Christine Lagarde are the right ones. We cannot fight, we know this, against inflation without a slowdown, unfortunately. The key question is, when do we rebound after a slowdown? So first on the slowdown, yes, we do expect some kind of a slowdown, but hopefully not recession, and not for long. And I do believe that the European economy and the French economy will rebound after a slowdown, helping us to get rid of inflation. So we know what's going to happen. It's quite predictable, even if it is difficult to give precise dates and timing, and we need to stand ready for this. And we in BNP Paribas, we stand ready to support the rebound, to support the clients when they want to invest and do business and export. So I think we know what's going to happen. It's rather predictable, and everybody should be ready to navigate in these circumstances.
Monsieur Chairman, do you see opportunity? No drama. Okay. Do you see opportunities in what has been a drama, the collapse of Credit Suisse? That certainly had the potential to be extremely dramatic, and it was in Switzerland, outside the Eurozone, of course, we know. But I wonder if you see opportunities here in hiring staff as UBS gets rid of staff. What does this mean for your business?
Well, first, it would be better to avoid these type of situations. You know, that's the job of regulation and supervision, to make sure that the system is safe. Fine. But it has been managed, and I would like to put stress on the fact that it was well managed by the Swiss authorities. They have done it quickly. A solution has been found, and I would like to insist on the fact that we have avoided contagion, and that's very key in the world. It is well managed. Second, there is a plan which is being put in place, as far as I understand, by UBS and Credit Suisse, and notably the management and the board of UBS. That will have an impact, for sure, on labor and business. I think it's too early to make a very clear assessment of what they are going to do. If there are opportunities, we shall look at them, but we are not seeking for this type of opportunities. That's my main comment. This is part of normal trend, and we shall see what's going to happen. We are not, you know, looking for these type of situations. That would be, in business, a mistake to do this. Now, if clients need a bank, we are among various banks ready to serve them. If staff want, okay, we shall look at this, but this is not, you know, an opportunity, and a positive opportunity. This is happening, that's all.
Yeah. Okay, look, you have a healthy balance sheet. You have a sizable balance sheet, $8 billion plus, and yet the stock is trading, what, close to 40% below book value? Do you need more clarity? Do you need, and the executive team need to be doing more to outline the growth strategy for BNP Paribas? And are there some organic opportunities or indeed some deals that will come to play in that?
First, I welcome your statement about the strength of the balance sheet of the bank. Yes, this is the main asset of the bank. We have a strong balance sheet, which has been built over time. It takes a lot of work, and you have to be careful to do this. It takes time, and we have it. And with a strong balance sheet, we can serve clients. They can have trust and confidence in what we can do with them. So I welcome your statement. This is good. On market reaction, you know, it's a long debate. We have a long debate about the valuation of stocks, difference between the US and Europe. You know it well. We have a high dividend, or reasonably high dividend. We serve well the shareholders. It's up to the market to appreciate the value they want to give, but of course, would welcome a better appreciation. Now, on the point you have made, which is, what are we going to do? The main trend in BNP Paribas is to support organic growth in a well-diversified business model we have all across the world, notably in global market activities. So you know that we have sold Bank of the West, and we are going to use the money of this operation to support the business, but mainly in an organic way.
Okay, so mainly the focus on that organic growth story. Okay, growth is supported. Jean, can I ask you about Paris as a financial services hub? It does seem that in terms of continental Europe's attempt to build up competition to London, that Paris has done very well at attracting banks to expand. Bank of America, JP Morgan, Goldman Sachs, Citigroup. Is this putting strain on any of the infrastructure? Is this something that we'll see more of?
Well, as a whole, the continent has done well. You have Paris, you have Amsterdam, you have Dublin, you have Frankfurt. All of us, I think, all the financial places in Europe have done well after Brexit. For obvious reasons. Clients are on the continent, and it's easier to operate from the continent and to serve the clients in the continent. This is the reason why most of the banks have shifted staff and skills to the continent. And Paris is probably leading this, which is positive from my point of view, for various reasons. It will continue. And you have raised a very important question, which is the quality of financial infrastructure on the continent in the Eurozone. We should never forget that since the decision was made on Brexit, the competitiveness of the continent, the work has been delivered. On the continent, people are working hard to build up better, stronger infrastructure, financial infrastructure. Time is running away, and with this, we see an increased competitiveness. So I know this is a debate, a sensitive debate between the UK and the city and the continent, but you know, people are working hard to improve, and they do, and you see the results.
Yeah. Yeah, and clearly you're relishing that shift, even as some here in London may not be. In terms of, I just wonder in terms of the appetite, the appeal of France, Monsieur Le Maire, and to what extent that's been dented by the protests, the unrest that we've seen over the last few weeks. There's the economic price tag, of course, and by some estimates about €1 billion, the costs of these protests. Is that a challenge? Are you concerned that that makes France less appealing as an investment destination?
Well, violence is bad and should be condemned. I have no doubt on this, and we should be firm on this. Now, you are very good observers of the French situation, and you know where it comes from, the why and the real impact. And I hope everybody understands well. The first point you have referred to is the pension reform. Well, it is to promote a reform. It was to promote a very much needed reform. It's not always easy. What we have seen over the last days is of a different nature. It's violence, and once more it should be condemned. But at the same time, I think hopefully it is coming down. What we have seen over the last hours is slightly better. I hope it will continue to improve. And let's be honest, France is not the only country in which there are tensions in the society. I have seen many of them in democracies, in the United States, in the UK, in other countries. It's part of the life of a democratic society. We need to understand this. It has little to do with competitiveness and attractiveness. We need to stay calm and understand well what's happening. I have no doubt that the impact on competitiveness of France and attractiveness of France is fortunately very limited, because investors understand well what it is all about. If we take a different view, then many other countries should have a concern.
Okay. Chairman, Monsieur Jean Lemierre of BNP Paribas, thank you very much indeed on the relative lack of impact. That's the view in terms of these protests and unrest on France as an investment destination and how they're planning to deploy that balance sheet. Thank you. We appreciate your time. Later today, we're going to be speaking exclusively with Spain's Foreign Minister, Jose Manuel Albares, about and as the nation takes up the presidency of the European Union. That conversation is at 4:30 p.m. London time. Stay with us for that. And coming up, we're going to talk central banks as the RBA holds rates, but warns further tightening may be necessary. Stay with us. This is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
DOJ or other authorities
could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
This is Bloomberg.
Welcome back. This is Markets Today. We are 50 minutes into the European trading session. A bit of a turnaround in terms of sentiment. Gains of 0.2% across European equities. The US, of course, is closed for Independence Day. At the top of the list when it comes to your sectors, real estate gaining 0.9%, followed by travel and leisure and technology. Let's check in on some of the individual stocks on the move now with Joe Easton. Joe.
That's right, Tom. We're going to have a look at some of those stocks that we mentioned earlier, see where they're settling up about half an hour into the trading day, or an hour almost. Sainsbury's then down 1.7%. Just in a note from Morgan Stanley, they're saying that the numbers in Sainsbury's report were actually only in line with what we saw from Kantar a few weeks ago. So therefore, there's a bit of disappointment that they haven't seen an increase since that report. Meanwhile, Virbac, the animal health company, down 9%. It was down almost 14% earlier over in France. There's a profit warning from that one, the latest weak spot over in the healthcare space. And also the UK home builders, Persimmon, actually trimming some of those declines. JP Morgan downgrading the largest UK home builder by market cap after 3 years, recommending buy, and also putting Taylor Wimpey on negative catalyst watch. Those stocks among the worst performers in London today. Going to bring up a few other stocks as well. One of them, Restore, I mentioned earlier. Shredded paper is the proxy of the day. That is the leading indicator in the market. That stock down 30% on the London mid-cap index, given their warning of this decline in recycled paper prices. That's a stock we don't look at too much, but it's grabbing some headlines today. Meanwhile, flow traders over in Amsterdam seeing a decline in some ETF volumes, people pulling money out of ETFs, given the sharp interest rate rises. There's better money to be made elsewhere at the moment. Finally, AstraZeneca trimming some of those declines we saw yesterday, dropped 8% following that weak lung cancer drug data. Deutsche Bank downgrading it to hold, but it is coming back up very slightly this morning. Maybe we'll trim some of those losses in the session. Keep an eye on Astra in London today.
Okay, Joe, thanks very much. Thanks to Joe Easton from our equities team with a rundown of some of the stocks that are on the move this morning. Let's talk about broader themes in markets. Christine Aquino joins us, managing editor of Bloomberg Markets Today, the partner blog of this program, if you like. Christine, good morning once again. Let's start with the central banking outlook, because not everything that happens in Australia stays in Australia in terms of the narrative around central banking. We saw a weak inflation print, and maybe that has justified this hold from the RBA. But other data had been strong, and so half the economists had thought we might see a hike. What do you take away, sort of broad themes from the RBA?
Well, Anna, I think what's happening in Australia is basically a great microcosm of what central banks around the world are really experiencing. They're having to conduct monetary policy on steroids over there just because of the nature of the economy, right? It's a small open economy, and so it has its own domestic factors, but of course it's very much levered to what's going on in China and all the undercurrents there, as well as what's going on in the US and other major economies. And so it's a really great example of the challenge of policymaking in this day and age. And I think, you know, the back and forth that we've seen from the RBA, where they were initially indicating they were done with their tightening cycle, and now it's a bit of a hold, but I guess a bit of a hawkish hold, really. The message there really just shows you how much policymakers have had to be nimble, have had to be dynamic, as just the reading from inflation and economic data keeps changing by the minute, it seems.
I love the fact you actually said Australia. with a bit of an Aussie accent. Did you notice that?
Trying to practice my Aussie accent.
Yeah, that worked. That worked. I don't want to
Very
spend too much
endearing,
time
I'm
on
sure.
Australia, given what's happening with the Ashes. So let's move to the UK.
Not that you're bitter.
Not that I'm bitter at all. Christine, there's a bit of good news when it comes to those of us fortunate enough to have some deposits and savings versus those of us looking to remortgage. Talk to us about a bit of a silver lining when it comes to the higher rate environment in the UK.
Well, Tom, yeah, I mean, I think we've all been quite surprised by the resilience of households and consumers in the UK, and now we know exactly why. That's because a lot of their savings that they've accrued over the pandemic, that's actually enjoyed a healthy growth because of higher interest rates from the Bank of England. And so data from the bank suggests that households are better off by about $10 billion a year in aggregate in terms of their savings growth. And so that is offsetting quite a bit the rise in mortgage costs that a lot of households are dealing with. And that's probably why we haven't seen really a total kind of collapse or panic in the mortgage market per se. Yes, things have been tighter, but it hasn't been catastrophic. The key question, exactly, that's right, exactly. The key question is what happens when all those fixed rate deals come to an end and everyone has to refinance? That is yet to happen. That's coming toward the end of this year. And so, you know, we'll see if those savings definitely hold up in the face of that.
Let me ask you about the broader Treasuries picture. We don't have Treasuries trading today. It's Independence Day, but so market's on holiday essentially. But there's a sort of row brewing, different views, I suppose, on whether yields go higher or lower from here. Morgan Stanley saying they go lower, 2 to 3% on the 10-year. Bill Dudley, formerly of the Fed, saying that rates go higher, up to 4.5% on the 10-year. We're currently at 3.85. So two different views there. We spoke to Mark Dowding over at Blue Bay Asset Management, and he was saying he's in the sort of Morgan Stanley camp. Yields go lower from here. What are you hearing?
Yeah, I mean, Anna, I don't think really there's a consensus over what's happening in the bond market. If you look at just the debate again between Morgan Stanley, Blue Bay, and Bill Dudley, or what's happening with the U.S. yield curve, right? That 2-10 curves, the most inverted since the 1980s. I mean, there's a lot of confusion over the direction of the bond market at the moment. And I think it really boils down to, you know, what investors take on the economic outlook from here is. You know, I think a lot of people who are saying yields lower from here, definitely looking at a slower economy, a bit of a cooling in both the job market in the U.S. as well as the manufacturing. We are starting to see signs of that already. And, you know, that fits in with a more of a economic slowdown or perhaps even a recessionary sort of outlook. But I think, you know, Bill Dudley's argument is that higher rates still here.
Christine Aquino from our Markets Today team. And, of course, you can find that on the Bloomberg UK website and, of course, by checking in on the terminal. These markets are turning around a little bit here in Europe. Gains of 0.2%. The US closed, of course. We continue to watch energy and the geopolitics of China, US. Stay with us. This is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. And market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Anna Edwards in for Francine Lacqua in London this morning. Here's what's coming up on today's programme. The RBA holds rates but warns further tightening may be needed amid continued inflation pressures. The Aussie dollar rebounds from earlier declines. Hitting back, China ups the ante in a trade war with the US and Europe, imposing restrictions on two metals critical for chip manufacturing. Plus, crude rises after Saudi Arabia and Russia announce an extension to oil supply cuts. Welcome to the programme, everybody. Welcome to The Pulse. I'm Anna Edwards in London, then in for Francine Lacqua this morning. Let's get straight to the markets and a quick check of where we are on some key assets. Of course, we are without the United States today. We see European equity markets going modestly higher, up by 0.2% we see this morning. S&P futures in there, even though we obviously know there's no trading of cash equities in the US later, but we do have the futures picture. It's not telling us a great deal, is it? Flat on US futures right now. In terms of the oil price, we're up 0.8%. Yesterday, we saw, as a result of that news out of Russia, that they're towing the line with Saudi Arabia, with their OPEC Plus colleagues. They're singing the same tune, if you like, and talking about restraining output. That did pop the oil price up to $76 on Brent, but it pretty quickly came back down to something with a 75 handle, and we continue to trade in around that range. 149.64 on dollar Aussie dollar. And what's been interesting here is we did see the Australian dollar a drop in the immediate aftermath of the RBA's decision. The economists had been split 50-50 as to whether we'd see a hike or not. We didn't get that hike, and so those who'd been anticipating it, perhaps a little bit disappointed. We saw a drop in the Aussie dollar, but that was short-lived. More hawkish rhetoric coming through from the RBA, so a sort of hawkish hold perhaps, and the Aussie dollar recovered a little bit. Let's have a quick look at the map for you across Europe then, and what we see on equity markets. So the Stoxx 600 up by 0.1% or so. We're flat on the FTSE 100 and the CAC 40 and the DAX. The IBEX in Spain moves a little lower. There's a lot of grey on that screen today, isn't there? Real estate is one of the best performing sectors. That is the only one, in fact, up by more than 1% on these markets. Basic resources under pressure today, down by 0.6%. Joining us to take a deeper dive into markets, Bloomberg Markets Today editor Christine Aquino is still with us. Columbia Threadneedle head of global equities, Melda Mergen, is with us as well. Welcome to both of you. Thank you very much for joining us. Melda, let me come to you first then. And thinking about, or jumping off the RBA's decision here to hold, does it tell us anything useful from a global perspective about the value in waiting for lags to sort of, for the real economy to catch up? Does it have any read across? Do you think we'll see more pauses from other central banks?
I think we will. I think all the central banks are really focused on bringing down inflation, but we also know that when they start tightening there is a lag, and I think it is a little bit of wait and see. We are starting to see around the globe every macroeconomic signals we are looking at, it's starting to slow down. So I think they are trying to assess how far they went.
Yes, and what do stocks do in the face of that? Because at one point, stock markets were very much being driven by expectations of what the Fed does. When we get to a pause, we know now, we had a pause already, whether we go back to hiking or not, this was the dominant narrative. But then you overlay that sort of tech enthusiasm for AI, and that was a different sort of structural factor coming through in recent months. So how does the equity market cope with higher rates?
Equity market does not prefer uncertainty. So anything that is not becoming a trend is a problem in the way of wait and see in the equity markets too. That being said, a lot of work being done in the equity markets as an investor is discounting the future cash flows, future earnings. So there are some secular trends, as you suggested. AI is one of them. Still will be focusing on it. When it comes to macro, though, I think equity market is pricing in the worst is over, and then waiting for the inflection point. So I think equity market is going to be also wait and see for a while.
Equity markets then, Christine, pricing in the worst is over in terms of rate hikes. I guess that's what you conclude when you look at the extent of gains that we saw in the first half of this year.
Absolutely, Anna. But I think, as Melda was saying, it's dangerous to kind of think that the rally is going to keep continuing from here, right? We have seen warnings from several investors saying, don't get too greedy in chasing the equity rally, because it does look like it's not over when it comes to rate hikes here. The Federal Reserve may have paused in June, but they're very much saying that, look, we're going to be data dependent. We're going to take a look at how the second half unfolds, but we're definitely far from over as far as trying to contain that inflation rate, which is still very much above their target. That is the case for a lot of central banks at the moment.
Melda, given that you head up global equities, I wanted to get your sense of the earnings season that is ahead of us. We've seen quite resilient profit margins in the face of much higher global inflation. Where do we stand on that story, on that narrative for you?
It will be another earnings season. I think we're going to hear more cautious message from the companies. They will start seeing maybe the effect on the consumer, as we are seeing in some of the leading indicators, that the consumer is definitely cautious and being careful with the spending.
You see signs of that then, consumer hesitancy?
Exactly, and it's around the globe. Everybody's cautious except UK. I think UK still has the tailwind from some of those savings being, because of the energy crisis carried over this year. But we see that, and companies are really, really trying to both manage the cost of capital side because of the rates being higher than usual, but at the demand side, which everybody's expecting, it's by design that the demand is going to slow down.
Okay, so yes, demand slows down, and that is by design. The cost of capital is an interesting one, because perhaps with long lags in this cycle, we've seen companies manage to push off the effects of higher interest rates because they use the opportunity, I was told in the last couple of hours of programming, to raise more money whilst rates were really low. Do you see that we're entering then a new environment where we don't go back to the low interest rates of the past, and companies have to get used to paying these kind of higher rates?
Yes, the equilibrium the next time with the interest rates or the inflation, I think, is going to be higher than what we experienced before the pandemic. So companies talk about it very openly. It's just that the way that they are coping with it, especially the winners in the market, is finding ways to keep that cost of capital, minimum debt, and also digitalization and other ways of making sure that their operations are more efficient.
So does interest rate cover become one of the factors you look at, one of the tools that you analyze balance sheets with at this kind of point?
Exactly, and valuation is going to be more important than previously. With low interest rates, valuation takes a second kind of importance in the way that you think about the cash flows in the future. But going forward, the conviction is the rates will be higher, so you need to pay more attention to valuation.
Okay, so Christine, so we pay more attention to valuation because interest rates are higher, and perhaps we focus in on interest rate cover, so businesses that are able to pay their interest rates essentially versus those that are not. I was talking about dividend payments in the same context with Ewan Munro earlier from Newton, and he was saying you've got to look really careful at these individual businesses, because just because some ratio might suggest they could pay their dividends, that we're entering difficult times where not all dividends are going to be certain. But income, an interesting theme right now.
Absolutely, Anna. And I think that's really something that companies are starting to look at, as Milda is saying, and really trying to be a bit more defensive on, And I think that's also evident from the overall kind of earnings season outlook that we've just gotten, both from the UK and the US. Like, a lot of companies still doing well, healthy profits overall, regardless of sector. But I think there's still that kind of undercurrent of caution that we've seen from their future outlooks. And so, you can tell the companies trying to kind of keep the powder dry for tougher times, trying to cut costs where they can, and again, trying to kind of address those interest rate driven costs now versus the future where rates could potentially be even higher from here.
Okay, Christine, thank you very much. Christine Aquino joining us from the Bloomberg Markets Today blog team. Melda, thank you as well. Melda Morgan joining us there from Columbia Threadneedle. Let's head on to matters UK and perhaps political. UK Prime Minister Rishi Sunak is set to appear before before Parliament's powerful liaison committee today, where he'll be quizzed by MPs, almost certain to come up, questions over the future of the scandal-hit Thames Water. I'm pleased to say joining us now, Sir Vince Cable, former UK Business Secretary and the former leader of the Liberal Democrats. Sir Vince is now a professor in the School of Public Policy at the London School of Economics. Vince, thank you very much for joining us. We appreciate your time. We've heard from a number of shareholders then at Thames Water that there is some enthusiasm for a capital raise. Does it seem then that we've avoided renationalisation at Thames Water? It's hard to see this as the end of the conversation.
Well, if the investors are willing to put in more cash, then that at least temporarily solves the problem. Of course, Thames Water isn't the only water company in trouble, but a capital raise from the government's point of view is by far the best option, though there will be painful conditions. I mean, I would imagine that the investors are expecting to see prices rise to ensure that there's an adequate return in future. But if the capital raise falls through, then the government is forced back into public ownership, because you can't just allow a water company to collapse. It's a fundamental service. And if that happens, of course, all the liabilities of the company go onto the public sector balance sheet, which in the UK are worrying. We're already 100% debt to GDP. So I think if the government can avoid nationalisation, it will, and will presumably have to make some concessions to the investors to stop that happening. Yeah.
How would you expect this to develop politically, Vince? There does seem to be some pressure from parts of the Labour Party, obviously not your political affiliation, but I'm interested in your assessment. Some Labour MPs calling on the opposition leader to reintroduce policies around renationalisation of water. Would you expect to see that?
Well, there may be calls for it, but I mean, the problem of actually how you handle public debt, which of course was the whole reason behind privatisation in the first place, was to try to get these big utilities off the public sector balance sheet. It remains a big problem, but politically there's a lot of anger around. I mean, after all, these water companies have failed to deliver some essential public goods. We've got this problem of overflow of sewage because of underinvestment in the sewage system. There's a lot of leakage. I mean, the real anger is essentially about things in the past. I mean, it's the way Macquarie took advantage of lax regulation to pay out very large dividends that were completely unjustified in terms of a fairly safe utility. I mean, that anger is there, but of course it's happened in the past. We can't retrieve the past. But the politics of this are quite toxic for the government.
Right, and so do you think that the sector has, I mean, some people have argued that the sector has a private equity problem, not a private ownership problem. From what you've been saying and the strains that renationalisation would put on the public purse, you might agree with that view.
Well, I think where this is heading is to a tougher regulatory regime. I think the problem is not a problem of privatisation, but more a problem of very weak regulatory operations. The regulators in some cases have been captured by the industry. You know, regulators went off to work for the private companies at much higher salaries. The regulation has been applied very flexibly. A lot of things have not been enforced, and I think the pressure will now be on to have a tougher regulatory regime. Now, how you reconcile that with trying to get in more private capital to make up the deficits of investment is a tricky one, and the obvious logic is to move to higher prices, which in turn is very difficult in the middle of a cost of living crisis.
What do you make of the sort of complex structures that seem to exist in some parts of the utility space in the UK, Vince? I'm talking here about layers and layers between operating and holding companies, parts of the company, or many parts of companies issuing debt. This was the situation at Thames Water. Some parts of the company relying on dividends from other parts, domiciled parts of the business in Luxembourg, Cayman Islands. Is there a place for these kind of complex structures in what were previously public utilities?
Yes, well, this is, of course, not just an issue for the water industry, but this is a phenomenon we've seen, and that was essentially how Macquarie, who in a way are somewhat the villains of this story, took advantage of Thames Water, were able to extract very, very large dividends, which were simply not justified. I mean, this is a low-risk utility, after all, and they took advantage of it. The regulators seemed to be unable to get a grip on it. And there will be enormous pressure, I think, from now, if the industry remains under private ownership, to severely limit the freedom of the shareholders to operate in these complex, tax-avoiding, dividend-maximising ways.
It seems Ofwat has recently increased its powers to link dividend payments to performance for customers and performance for the environment, Vince. Is that moving in the right direction?
Yes, it is. And there is, of course, a complex issue of regulation here because there are different agencies managing regulation. You know, the Environment Agency has been dealing with one set of issues, Ofwat with another. And, of course, there are other aspects of regulation feeding into all of this. But a consolidation of regulatory functions and a strengthening of them is clearly what's now required. But, you know, there is always an element of this that you're closing the stable door after the horse has bolted.
So Vince Cable, thank you very much for joining us, former UK Business Secretary. Thanks for spending time with us here on Bloomberg Television. We'll have more on Thames Water coming up later in the programme. Coming up, Beijing is to impose restrictions on exporting chip-making metals. More on the US-China tech standoff next. This is Bloomberg.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. You know, I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that, you know, peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it is causing quite a lot of anxiety, which means, you know, for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, you know, it's very different, and it's not something people have had to operate in for a long time.
News breaks. No one covers the world like Bloomberg.
The image of Vladimir Putin as the all-powerful leader has been rattled already.
History was made here at the federal courthouse in Miami when Donald Trump became the first ever former president to ever be arraigned on federal charges.
We're going to need a new engine technology, and that's where the real battle lies. And whoever makes that decision first is going to have a huge impact on this industry.
Bloomberg, your global business authority.
Welcome back to The Pulse. Now, the tit-for-tat technology clash between China and the West is escalating. Beijing says it's to impose restrictions on exporting two metals used in the semiconductor, telecoms and EV industries as the US and China battle for technological dominance. Bloomberg's Rebecca Chung-Wilkins joins us with more. Rebecca, tell us more then about these curbs, not an entire ban, but curbs on the export of two metals in particular.
Absolutely, Anna, and that's important to remember. Just a restriction. It's a restriction on two key metals that are used in a variety of industries, but critically here, semiconductors, defense, and communications. Now, these two metals, it's not really an issue of how rare they are, but how costly it is to produce them. And they really produce as a byproduct of refining other types of commodities. And China supplies at the moment about upwards of 80% of the world's use of these two metals. So the really big picture here is basically that China is showing a new willingness to try and tackle and push back against containment.
And how significant is this? As you say, not a full ban, it is just a sort of reining in of some of the export. And what are the longer term implications?
Well, there is this risk that actually this move does eventually backfire on China. And we have seen a similar attempt, for example, by China to limit its exports of rare earths in the past. And eventually what happened was that actually countries just accelerated their efforts to sort of diversify their supply chains and remove that out and essentially just diminish China's portion of the market share. So the risk is that if China does enforce a sort of sweeping, more rigorous curb, as you say, we don't really know what this is actually going to look like, how much is going to be limited to other third nations. But if China does move to this, it could really just emphasize and sort of accelerate that move by the US and allies to find alternatives to China when it comes to these two specific metals.
Yes, and our story does point out that it is possible to find alternatives. Rebecca, thank you very much for joining us. Bloomberg's Rebecca Chung-Wilkins with the latest on that geopolitical tension and the mining sector falling into that. Coming up on the programme, we'll talk about extraction of another variety. We'll talk oil. Saudi Arabia is planning to extend its oil production cut by a month, keeping a lid on supply as fears remain over the global economy. More on that next. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back. Let's focus in on the oil sector. Oil futures are making gains. That's after Saudi Arabia said it will prolong its unilateral output cut of 1 million barrels a day through the month of August, warning it may extend even further to prop up prices. OPEC Plus ally Russia announced fresh curbs on its exports. Let's bring into the conversation Bloomberg's oil strategist, Julian Lee, who's with us in studio this morning. Julian, good morning. So how significant is this move from Saudi Arabia and Russia?
Well, I think it's potentially very significant as long as both countries actually make the cuts that they've promised. Saudi Arabia generally does exactly what it said it will do, so we expect this output cut that they've now extended from July through August at the very least, and they may yet extend it further. We expect that to be made. For Russia, their history so far is much less clear. They announced output cuts back in February to come into effect from March. We've seen no sign of those in any of the export figures, and that's what really matters, the amount of oil leaving Russia to the world market. So we wait and see whether Russia actually implements this cut, and if it does, then I think it's significant.
Okay, so that's where we see whether this is significant or not. And what about the ability of this cut to put a floor under prices? Because we saw a short spike up in prices and then back down to $75 again on Brent.
Yeah, I mean, I think that we are moving into a period of the year where almost everybody is expecting the market to tighten. If you look at the major forecasting agencies, I mean, OPEC itself, the International Energy Agency, they are seeing a very significant supply shortfall in the second half of the year. Most of the banks see the same, although they have trimmed back a lot of their price expectations. But if we do get an additional 1.5 million barrels a day taken off supply in both July and August, and then possibly extending that further through the year, I think that will be enough to put a floor under prices. But as I say, it really depends on those cuts actually being made.
Julian, thank you very much. All eyes then on Russia and whether they do what they will say they will do in terms of production levels. Oil strategist here at Bloomberg, Julian Lee, thank you for joining us. Coming up on the programme, I'll be speaking to the Allianz chief economist. Ludovic Subran joins us shortly. We'll talk about the outlook for the global economy. We'll get his take on the resilience of the financial sector as well. When we last spoke in the month of May, he talked about financial accidents, and he was worried about those and their ability to drive down liquidity. Is he still concerned about that? Still concerned about the commercial real estate sector and its linkages into the banks over in the United States? Or can we put some of those concerns behind us? We will talk about that conversation coming out to us from the Europlus conference taking place in Paris. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
believe it's summer already? That means it's time for the Boston Pops Fireworks Spectacular. And Bloomberg will make sure you see all the fireworks, music, and special appearances by pop superstars En Vogue, chart-topping country duo Low Cash, and film, TV, and Broadway powerhouse Mandy Gonzalez. Plus the U.S. Army Field Band and the cast of the Broadway musical Ragtime. It all starts July 4th at 8 p.m. Eastern, right here on Bloomberg Television and Radio.
From New York City.
In London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Welcome to The Pulse. I'm Anna Edwards in for Francine Lacroix this morning. Let's get to our headlines. The RBA holds rates but warns further tightening may be needed amid continued inflation pressures. The Aussie dollar rebounds from earlier declines. Hitting back, China ups the ante in a trade war with the US and with Europe, imposing restrictions on two metals critical for chip manufacturing. Plus, crude rises after Saudi Arabia and Russia announce an extension to oil supply cuts. Welcome back to the programme. As I said, I'm Anna Edwards in for Francine Lacroix on The Pulse this morning on Bloomberg TV. Let's get to some important research and another perspective on the global economy. Allianz Research expects the global economy to stage a timid recovery from mid-2024 after a soft landing. The Allianz chief economist Ludovic Subran joins us now from the annual Paris Finance Forum that is Euroclass. Thank you so much for joining us, Ludovic. Very nice to have you with us. So that suggests a fairly decent soft landing for the global economy. Is that what you're expecting to see?
Yes, well, it depends vividly on central banks' determination to kill inflation, I mean, what is fascinating today is one of the main risks to the economy is the risk of policy mistakes from central banks and this toxic policy mix risk between fiscal and monetary tightening at the same time. So behind our soft landing, even though I don't find any landing to be soft in history, there is this assumption that, policymakers do the right thing at the right time. So maybe don't, pull the plug too strongly, too fast on the support mechanisms, especially in the US and Europe, of course.
Well, but I wonder, I'm interested in what defines a policy mistake from a central bank, Ludovic. If we end up in recession, but it can be justified by the fight against inflation, does that equal a policy mistake, do you think?
Look, last week I was in Sintra for the ECB forum, and the President Lagarde actually mentioned that she's going to be looking at some of the pass-through, some of the transmission uncertainties and so forth. But for me, what would be a policy mistake would be the decision to wait for the full pass-through, meaning this data dependence, obsession that central banks have, could yield to a moment where we decide to pivot when it's already too late, which means the embedded tightening from central banks to the real economy is already visible. And for me, this is already too late. So that's a policy mistake. And this is a little bit the discussion that happened last week in Sintra, which is what would happen if the ECB were to hold rates high on top of adding a couple more hikes for the full of 24 to see the full transmission. This, for me, would qualify for a policy mistake because that would mean we would start seeing the real economy effect of this embedded tightening. And so that would be already too late for the central bank to pivot.
Ahead of 2024, though, I assume, Ludovic, when do we get to a position where the ECB can hold and does not need to be hiking anymore? Of course, we've seen this pause, or maybe it's a skip at the Fed already.
It's interesting. I think what came up a lot last week was this wage price spiral risk, which seems to be quite the question that everybody has in mind in Europe, because we've seen some inflation in the services sector. And we also know that some countries in Europe have some form of indexation or maybe a public sector wage bill that is very strong, and that leads to some form of additional, upside risks, I would say, on the wage bill. You also see what's happening a bit on the social risk in a lot of countries. So I think the risk now is to say, okay, maybe they will hike till they see that wage inflation and especially services inflation is under control. That could be, let's say, in the fall. So I would say a couple more hikes, and then they hold still as of Q3 or maybe beginning of Q4 this year.
Ludovic, last time I spoke to you was back in the month of May, and we were talking about, well, we were talking in the aftermath of all the turmoil in the banking sector over in the United States in particular, well, and then in Switzerland, obviously, notably. You at the time were concerned about financial accidents driving down liquidity in markets. Do you still have those concerns?
Of course. They haven't disappeared, you know. This is the good news is I would say that at least in Europe we have avoided, I would say, the contagion risk of the banking crisis. This is good news. That means that the banking crisis we had 10 years ago was a good fire drill, and that we've built the right tools to avoid, I would say, such a liquidity crisis. But I still see a lot of leverage and a lot of concern about credit risk. And to be fair, a lot of financial institutions also that need to continue to do the right stress testing. And remember, the financial accidents could also come from exogenous shocks. Think about climate risks that is really piling up, and that is creating a new form of exogenous risk for some of the financial institutions. So I stand by my call to be very cautious with the liquidity situation altogether for at least the next 12 months.
Okay, so be cautious around liquidity on that 12-month horizon. Can I ask for your more broad outlook around inflation, Ludovic? Are we in a regime where we don't see interest rates going back to post-GFC levels? Do you expect that we will never return to the low interest rate environment that we saw in decades past?
No. I think, you know, inflation, I don't want to say inflation is transitory because that would be quite a bummer. But to be fair, we start to see really the effect of hiking on inflation. We also see the softening of consumption in some countries. So I would say we're going to be certainly, you know, the experiment of zero interest rate is certainly behind us for quite some time. But I don't think we can stand, you know, 5% in the US or 4% in Europe for more than, I would say, a year or so. So I expect that there will be some cuts on interest rates. I also expect inflation to be back under control. Like a lot of people, I'm worried about the residual inflation from fragmentation and decarbonation and demography. But we're talking maybe of about 0.5 point of percentage. So maybe something hovering around 2.5% instead of 2%, which is something that maybe central banks will have to answer in the coming years, which is whether the 2% target makes sense when you look at the labor market. But I don't think we're going to be at 5% inflation and 5% rate for the following 5 years. This is going to get normal again. Don't worry about this.
Okay, I won't worry then, Ludovic. We'll look forward to what we would have called normal some time ago. But you did mention some of those structural factors that do put upward pressure on inflation. You mentioned fragmentation, the decarbonisation, demography, all of those well quoted. I was drawn to a comment by Megan Green, who's soon going to be joining the Bank of England yesterday, and she was actually talking about the way that AI could be inflationary. Do you have thoughts around AI and the impact? Because more traditionally, we might have thought that technology would put a downward pressure on inflation.
Actually, last March, we wrote a report which was called the 5 Ds of inflation, and there was demography and decarbonation and deglobalization, but there was also digital and debt. So we were also worried about the fiscal profligacy, creating a bit of additional order books that were creating a bit of inflationary pressures, but we were worried about the tech sector being slightly inflationary now after decades of being deflationary. The reason is behind this are the cartels, the oligopolies, the fact that it's a very little competitive market. You have this, you know, winner takes all, and so that's not good for price setting mechanism. And the second reason is because a lot of the ecosystem, I would say, around tech is inflationary by nature because it requires a lot of investment. And so you need a bit of overheating to make sure that there is this capex, this investment going into this sector. So those were the two reasons why I would agree also with Megan Green on this idea of tech being slightly inflationary going forward.
Ludovic, thank you so much. Very interesting conversation. Thank you so much for joining us. The Allianz chief economist, Ludovic Soubrand, joining us from the Europlast conference taking place in Paris. Coming up on the programme, ESG funds that bought into Thames Water's green bonds are in perhaps hot water. And is it clean enough for them? This, as the UK's largest water supplier, teeters on the brink of bankruptcy. We will dive into that story next. This is Bloomberg.
watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
The top names in business are on Bloomberg.
For Indigo, this is a 500 planes order. That's the biggest order ever in terms of number of planes. It doesn't change the short-term perspective on ramping up the production.
All our aircraft deliveries are delayed. The supply chain that was really decimated during COVID.
It's a real challenge for all the OEMs at the moment, but we absolutely have to have those aircraft delivered on time.
Nobody covers business like Bloomberg, your global business authority.
Welcome back to The Pulse, the conversations that matter and the insights you need. I'm Anna Edwards in London, in for Francine Lacroix this morning. Now, ESG funds that piled into green bonds sold by Thames Water are facing a dilemma. That's after a string of environmental, social and governance disasters hit the UK's biggest water company. Former UK Business Secretary Vince Cable spoke to Bloomberg earlier on the troubles the company and the government are now facing.
Thames Water isn't the only water company in trouble, but a capital raise from the government's point of view is by far the best option, though there will be painful conditions. I mean, I would imagine that the investors are expecting to see prices rise to ensure that there's an adequate return in future. But if the capital raise falls through, then the government is forced to back into public ownership because you can't just allow a water company to collapse.
So Vince Cable there, and to his point, Ofwat itself has actually expressed concern about the financial resilience of Thames Water, Yorkshire Water, SES Water and Portsmouth Water. Let's talk about another angle on this story. Tasneem Brogger joins us, who oversees Bloomberg's sustainable finance coverage for the EMEA region. Tasneem, very good to have you with us. So Thames Water has a lot of bondholders, but this is also, there's a big green investor base here, green bondholders specifically. How are they approaching this crisis?
That's exactly right. I mean, obviously, all bondholders in Thames Water at the moment are looking at this situation very closely and wondering how it's going to unfold. But there is, as you say, specifically a group of bondholders that sought out Thames Water debt investments because they thought they were extra green and extra protected from environmental disaster. We worked with Morningstar and identified more than 200 ESG funds that hold about $240 million worth of green bonds that were issued since 2022. And obviously, since that time, the headlines have been full of stories of sort of sewage leaks and the extent to which Thames Water has been, they themselves acknowledged, behind environmental damage. We've had some investors, we spoke to Schroders, that last year they said it was too much, even though the green bond is ring-fenced, it's only supposed to be use of proceeds that you look at, but they said the fact that the issuer is so engulfed in problems, they were getting out. We've had other investors like Nordea say they wouldn't even touch them in the first place.
Okay, all right, so that's really interesting, the different views that exist on the green bond. I mean, what does this tell us about the ESG debt market if you can get into quite so much trouble with regulators over pollution and then still be considered green? Has the ESG sector or environmental bonds, green bonds, have they focused too much on carbon and not on other things?
Yeah, so I mean, the green bond is sort of unique in that it has a use of proceeds clause. So specifically, as an investor, you think, okay, well, I'm only looking at how the company is using the proceeds that I've given them for this particular bond.
And it's for a greening purpose, is that the idea?
Precisely.
Right.
But in the case of Thames Water, one can see that obviously some investors are starting to look at the issuer themselves and the wider problem that the issuer potentially finds themselves in. We've had UK SIF, which represents sustainable investors in the UK, the CEO come out and say, you know, you can't be blindly ignoring the circumstances around the issuer, even though the bond is supposedly ring-fenced. We've had the new CEO of Thames Water, Adrian Montague, come out and say, look, he's going to work with investors and with regulators and try and sort of sort out the issue. But clearly, it's something where green bond investors investors are sort of starting to wonder, is it enough just to look at the use of proceeds?
Can it be called a green bond if you're just very much at the beginning of the greening process, even though that's where a lot of the money will be needed? Tasneem, thank you very much for bringing us the story. Bloomberg's Tasneem Brogger with that really interesting take on Thames Water and the ESG dimension. In more ESG news this morning, Spain is ramping up over 18 billion euros in green hydrogen investments. It's Europe's most ambitious effort yet to implement technologies critical to becoming the world's first climate neutral continent. But will the demand be there? Bloomberg's Chris Reiter joins us now with some thoughts on this. And Chris, where and how is this money going to be spent then by Spain?
Yeah, well, it's a broad-based investment program. It runs like all across the country from the north to the south to Valencia. The biggest hydrogen generator is in Puerto Llano, which is just south of Madrid. And the kinds of investments run from generation to transport.
Right, so it covers a whole host of things. And where's the cash coming from?
Well, it's coming from, there's private investors, there's companies like Cepsa, which is a refiner, there's Iberdrola, which is Europe's largest green energy developer, and then there's government money, a lot of government money. There's government money from the Spanish government and from EU funds as well that are helping fund a pipeline that's going to bring that hydrogen, allow Spain to export some of that hydrogen to France and beyond and on to Germany.
Other countries not pushing quite so quickly on the green hydrogen front. Why is Spain taking the lead here compared to some of the other European nations?
Yeah, well, it has an advantage in terms of its solar power, and it has that massive amount of space. It has the best conditions in Europe for solar power. So that's a key component of green hydrogen is cheap, clean energy, and that's what Spain has, and that's why it's pushing it, and that's why it's trying to get into the space before anybody else, to be honest.
Chris, thanks so much. Thanks for bringing us the story, really important story on the Bloomberg terminal this morning around Spain and its hydrogen push. Bloomberg's Chris Reiter joining us there with details. Later today, we'll be speaking exclusively with Spain's Foreign Minister, Jose Manuel Albaraz. That conversation later today as the nation takes up the presidency of the European Union, 4:30 p.m. London time. Stay with us for that. Coming up in the next half hour of programming, it's Musk versus Zuckerberg, apparently. Instagram's answer to Twitter looks set to launch later this week. Will the new Threads platform be a threat to the incumbent? We'll discuss that next. This is Bloomberg.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Welcome back to the Pulse. I'm Anna Edwards in London, in for Francine Lacroix this morning. Let's get a check on the markets, shall we? And this is the picture we have for you right now. Across European stocks, up by 0.2%. Of course, no trading in the United States, no cash trading of equities. We've got the futures picture in there, but we know there's no cash trading today. It is the 4th of July, so happy Independence Day if you are celebrating wherever you are. So S&P futures do show a little bit of downside, but no great movement. In terms of the sector breakdown, we've got real estate and healthcare doing pretty well today. Construction and materials, energy, basic resources, those are the laggard sectors. The Brent price, as you see there, up by 0.8%. Yesterday, we heard from Russia joining Saudi Arabia in its push to try and put a floor under prices. How effective will that be is a big question. We talked to our colleague earlier who was suggesting it all depends whether Russia sticks to the commitments it has made. For the moment, we've seen a little bit of upside on the oil price. 75.27 is where we trade after we popped higher to 76 in yesterday's session, but have come down. The Australian dollar actually dropped this morning after we heard from the RBA. They didn't, as half of the economists had expected, they didn't hike rates. They paused on rates. And that's an interesting talking point, really, in terms of the global central banking narrative. Does that tell us anything useful about the value of a pause? We certainly heard that view from Ewan Munro over at Newton earlier on. But the Aussie dollar then recovering a little bit from that earlier sell-off. Let's get to some top stories this morning that we're covering here at Bloomberg. Lazard is said to have fired a senior dealmaker after allegations of inappropriate behaviour during a weekend party. Bloomberg sources say the managing director was sacked for actions that were deemed incompatible with the values of the company. Incoming CEO Peter Orszag informed staff about the move on Sunday via an internal memo. The document did not name the individual or disclose details of the incident. Harvard University has been accused by minority groups of violating federal law by giving preferential treatment to children of alumni and wealthy donors. The complaint comes days after the U.S. Supreme Court struck down the use of race-based affirmative action policies. The minority groups say the long-standing practice of legacy admissions favors white students and breaches the 1964 Civil Rights Act. Alibaba is said to be exploring options for its video entertainment assets. Youku and Tudu, as the Chinese tech giant wades deeper into its plan to revamp its structure. Sources tell Bloomberg one of the options under consideration is to inject the assets into Alibaba Pictures Group and bolster the business scope of the Hong Kong-listed company. Meta's Facebook has lost its fight at the EU's top court to topple a German antitrust decision that imposed an overhaul of the US tech firm's business model. The court says that the Federal Cartel Office didn't overstep its powers when it slapped the social media firm with its landmark 2019 order. The case is viewed as a test of how far European antitrust regulators can go to make sure Silicon Valley firms don't mishandle massive data sets gleaned from users to cement their market power. Now, two more big tech stories for you today, and we'll discuss these. Instagram's answer to Twitter Threads to Twitter, and it's called Threads, is expected to launch on Thursday, while Yahoo wants to make a comeback by taking the company public once again. That's according to the Financial Times. Alex Webb has been digesting both of these stories for us. Bloomberg Quick Take correspondent and joins us now. Alex, good morning. So let's start with Twitter rivalry. So Threads coming from Instagram and Meta. What should we expect to see? I think Thursday is the date we expect to see the launch.
Yes, that's certainly what the App Store seems to indicate. You can sort of pre-order it, as it were. It's a free app. You can say you intend to download it, and then when it becomes available, it will download onto your phone. It says expected, essentially, on Thursday. It is really their effort to capitalize on all the issues, partly, prompted by the Elon Musk takeover at Twitter. It's been losing advertisers. There have been changes to the platform which have made people concerned about trust and whether the content getting there is safe, particularly for advertisers. So Facebook is looking, or Meta is looking to capitalize on that by introducing this app Threads. It will be linked to your Instagram account. The interesting piece really is they have got a track record of like essentially mimicking. I think they've even said openly they copy other people's.
And some of those have been successful.
Exactly. So we've seen Instagram has had pretty good success with Stories, which is a pretty shameless rip-off of some of the functionality of Snapchat. In fact, the Snapchat CEO's wife said that his job should be described as the CTO of Instagram. They also have some that are failures. Like, do you remember Facebook Paper, for instance?
No.
Facebook Paper was their effort essentially to do Flipboard, to bring a magazine or a mobile native magazine app to smartphones. It went nowhere, it died a death. So the question is really, is it going to be Paper or is it going to be Instagram Stories?
Okay, really interesting. So they've got some success, but also some examples of where they've not been successful. Let me ask you about this blast from the past, it almost seems like. Yahoo wanting to go public again. What's prompting this?
Well, it's owned by a private equity company. So, you know, it was a private equity took it off the hands, Apollo took it off the hands of Verizon, who owned it for about 5, 6, 7 years. They paid $5 billion for it, as ever with the private equity company. They're going to be seeking an exit at some stage. So even if we may not be using it on a daily basis anymore, it remains a top 5 website globally by some measures, by traffic, really. That means there is clearly potential to monetize that. The really interesting thing will be having a glance at the financials as it gets on an IPO roadshow to see exactly what has happened while it's been in private hands. I can't wait to have a look under the hood.
Yeah, absolutely, to see what debt levels look like or the like. I wonder if they'll mention AI, Alex.
I think there's a pretty safe bet that
I mean, if you're doing something in tech and it's 2023, then I think
Yahoo-based AI drinking game will get everybody in trouble.
Okay, we'll look for that in the prospectus. Thank you very much for that. Bloomberg Quick Take correspondent Alex Webb with the latest on a couple of tech themes this morning. Just time to tell you about this last story. The world's wealthiest have added more than $850 billion to their fortunes in the first half of 2023, with Elon Musk and Mark Zuckerberg leading the surge. That is according to the Bloomberg Billionaires Index, which showed the 500 members of that index made an average of $14 million per day in the past 6 months, just demonstrating, I suppose, the strength in stocks that we saw in the first half of the year and what that did to the fortunes of these world's richest. Up next, Bloomberg Markets with Yusuf Gamal Eldin. It is Independence Day, no US trading. European stocks go modestly higher. This is Bloomberg.
Manchester, not London, is the best place to find a new job in the UK. That's the surprising finding of data analysed by Bloomberg from Reed Recruitment. While you might think that London is the biggest pool of jobs, which it is, Manchester is leading the way when you look at the number of jobs per local worker. Thousands of voters in the so-called red wall seats flipped Conservative in the last election, hoping that the Conservative government would be able to bring more wealth and prosperity to their area. However, the data still show a country where employment prospects are thin on the ground in large pockets of the northeast, northwest, and areas all around the coast. Aside from Manchester, the only areas that are really leading the way are Cambridge, Reading, and Milton Keynes, indicating the good news for the rest of the UK might stop there. With Prime Minister Rishi Sunak facing the prospect of a general election as soon as next year, the pressure's now on for him to find ways to spread wealth outside of London to some of those more neglected areas. In Chancellor Jeremy Hunt's budget, he unveiled plans for 12 new low-tax investment zones around the UK and £760 million of spending on infrastructure and regeneration. Manchester's one of the oldest devolved areas in England, and there are signs that that's really beginning to pay off. What's on Jeremy Hunt's plate now is whether he can spread that success to other regions.
our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg.
Good morning. I'm Yusuf Gameneddin in Dubai. Welcome to Bloomberg Markets. U.S. markets are closed for Independence Day. Our top stories today. Hawkish pause. The RBA holds rates but warns further tightening may be needed amid continued inflation pressures. Recession risk, a key segment of the U.S. Treasury yield curve, approaches its most inverted level since the early 1980s as traders price in further Fed policy tightening. And the tit-for-tat technology battle between China and the West escalates as China restricts exports of key metals. First, let's get you a check of the markets then, because yes, sure, you've got U.S. cash equities and treasuries that are closed. They're going to resume trading on Wednesday. But we have some other indicators to work with as investors model the risk to economic growth and they brace for upcoming earnings. We're lower on the stocks Europe 600. Initially, we're up now by 0.1%. Although sentiment is still negative on U.S. equity futures. I want to flip the board and get to the big mover this morning, really in Australia. Initially out of the gates with some repricing off the back of the Reserve Bank of Australia decision. Bulk of the intraday gain on Aussie 3-year have now been erased. The RBA holding the cash rate at 4.1%. That was predicted by about 60% of economists surveyed by Bloomberg, extending a series of staccato-like policy moves. Your Eurodollar is 108.96, and then Brent crude currently 1% higher as we digest the latest salvo from OPEC Plus, including Saudi Arabia and Russia, to try and prop up prices by curbing supply. Let's get into a bit more detail on the Treasury 2s10s curve inversion, because they're now back to levels that we last saw in March, that was before easing on U.S. manufacturing data. The levels are basically some of the same that we saw all the way back in the early 1980s. Discuss this more. We're joined by Anna Stupnitska, global macroeconomist at Fidelity International. She joins us now. So Anna, what's your initial read then on the extremities of the yield curve inversion? What do you take away?
Well, I think from the macro perspective, we do believe that it's a recession signal. And as we know, it's been a pretty reliable indicator, even before the COVID recession, which was probably didn't have anything to do with inversion to a large extent. So we do think this is signaling recession. But there are also some technical factors that are probably playing a role, but the overall macroeconomic signal is pretty clear, we think.
I mean, bond investors are clearly betting on a recession. They'll need a brutal recession if bonds are going to outperform. I'm wondering what a path to a potential soft landing could look like, or is that now, a needle in the haystack?
Well, we think that surely there is a path to soft landing, but it's a very narrow path, and we think the probability is very low. Let's say we see a smooth decline in inflation, in core inflation from here, going back to target, perhaps the labor market start easing. Again, it's smooth. And there isn't too much of a rise in unemployment rates across the board, and that should allow the central banks to potentially pause and then start easing. Now, this is an ideal scenario, which I think the central bankers want to achieve, but it's very unlikely because the transmission mechanism is non-linear. Markets are non-linear, and we are yet to see that hit to the real economy from all the tightening we've seen so far. So we don't think a soft landing is likely at this point.
I want to rope in some of the U.S. economic data that we got, and specifically the ISM manufacturing data. I mean, wow. I mean, it is a shocker. It doesn't matter how you look at it. We have a chart that tells the story, 8 straight months of contraction, employment falling below 50. Does that underscore the narrative about a growing weakness in U.S. economic activity?
It does, and as you know, it's not just in the U.S., it's across the board, particularly in developed markets, including Europe, and that shows that we are seeing real weakness in some parts of the economy, and really that resilience that we see on the surface is just driven by consumer and by the services sector. Now, that is mainly related to those COVID-related excesses, excess savings, of course, we talked about it so much, but that is fading. Those tailwinds are fading, and we think that it's the service sector that will start adjusting soon to that manufacturing weakness and closing the gap rather than the other way around. So certainly there is weakness. It's patchy, it's only in certain sectors, but we are expecting that to broaden out in coming months.
How do you approach then the strategy point of view? Because we're gearing up for earnings season. I'm not sure what you're expecting, but the street is definitely getting a little bit more cautious. How do you advise clients to go around the next few weeks?
We are cautious from a multi-asset perspective. And this is the next, the view, say, for the next 3 to 6 months. We are underweight risk. We're underweight equities, underweight credit. We are overweight government bonds. And of course, there are some views sort of within those broad asset classes. But we do think that we might as well see a few weeks of good performance and equities drifting up and potentially yields going up. But we do think this is going to reverse soon as we start seeing that broad weakness in the economy while inflation stays high. We have that view that inflation is persistent and it's not going to be easy for central banks in coming months to really get it back to target. So very much cautious on risk, and this is what we talk to clients about.
There is significant news flow around the U.S.-China relationship in the last 3 to 4 hours. Whether you call them tensions, whether you call them frictions, the reality is that they could lead to reduced supply or more rigid supply chains at a minimum. Could there be another wave of increased inflationary pressure as a result that's being underpriced?
Absolutely, and these are risks that are still there. Some of them are tail risks, and some of them are sort of higher probability risks on the horizon. And we do think that the risks to inflation are skewed to the upside from more structural things like trade tensions. Again, the Russia-Ukraine war is still ongoing. And the news today about the U.S.-China related restrictions just tell us that this reshaping of supply chains is going to be a big theme and will continue to be a big theme. It will take time to play out, and it will be inflationary. That's something that we take into account, not just in the near term, but also on the longer term horizon when we think about where inflation might settle. And we think that's going to be above the target for a significant number of years from here.
I mean, it sounds like you would agree with the ECB's Joachim Nagel, who makes the point that there's still quite a bit more work to do to bring inflation down, and that inflationary risks are really to the upside for the second half of the year. How does the ECB get a lid on that?
Well, they are clearly determined to hike more, and we think maybe another 2 hikes they're going to push through on, or potentially more. It's interesting that when we compare inflation dynamics across the board, European inflation is a bit less entrenched than that in the US and the UK. So we do think that the ECB will probably be one of the first DM central banks to reach that peak rate and stay there for longer. So I think rather than taking rates too much higher from here, well, beyond the 2 hikes that they're about to do, they will try to stay there for longer, higher for longer, to try to tame inflation.
And after having spoken to the rest of your team, what are some of the conclusions about what is left of economic growth at the end of 2023? How much do we get across the line from what you can tell?
Well, in terms of where we are heading, we think we are heading towards recession towards the end of this year. Again, across the board, particularly here in the UK, given how much the BOE has to do to rebuild that credibility and to tame inflation. So we think the second half of the year is pretty weak, and as we get to Q4, we might see really weak or negative growth across the board. Perhaps stagflation or stagnation is something that we're going to be talking about towards the end of the year. And then, of course, depending on how fast the economy adjusts, how fast inflation falls, the central banks will be ready to pause as we move into 24 and hopefully start cutting rates.
It's all about recalibration and readjustment. Anna, super to see you. Thank you for that. That's Anna Stupnitska of Fidelity International. Let's get you a bit of a snapshot of what else is still to come. Stock markets pause in terms of the rally after a strong first half. We'll have more on that next. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
News breaks. No one covers the world like Bloomberg.
The image of Vladimir Putin as the all-powerful leader has been rattled already.
History was made here at the federal courthouse in Miami when Donald Trump became the first ever former president to ever be arraigned on federal charges.
We're going to need a new engine technology, and that's where the real battle lies. And whoever makes that decision first is going to have a huge impact on this industry.
Bloomberg, your global business authority.
My view is you end up with growth disappointing a bit and inflation disappointing on the high side a bit, ending up, probably bad for bonds and probably, a little bit bad for equities and generally weak growth.
That was Bridgewater's Greg Jensen weighing in earlier when speaking on the Bloomberg podcast Odd Lots. I want to widen out the discussion, get to Bloomberg's Ksenia Galauchko. She joins us now from London. So, Ksenia, give us your first take then in terms of how you reconcile that with some of the other views in the market.
Yeah, I mean, the second half of the year is most likely going to be much more challenging for equities. I mean, we've seen a very surprising and super powerful rally in the first half. And basically, even with the economic weakness, even with the fears of recession, even with the Fed and other major central banks sounding very cautious and hawkish, the equities rallied in the first half of the year. So the general outlook for the second half among major strategists and investors is that we will not see these double-digit returns. Tread carefully. Look at defensive sectors, look at companies that are undervalued, and perhaps start taking profit on some of these more expensive growth stocks, like the tech stocks that have rallied the most in the United States this year.
What about the note from JP Morgan? I mean, yes, maybe the first 6 months of the year may be as good as it gets when it comes to earnings, but where could we see sort of potential for differentiation within that spectrum?
Yeah, so this upcoming earnings season in July is going to be very interesting. The view on the street is that this might be the last positive earnings quarter that we get for a while before the US and Europe get hit by recession at the end of this year or early next year. Now, we've already started hearing warnings from major companies like chemical producers like FedEx, and investors are looking out for that, and they're going to most likely start taking profit ahead of the earnings season. And then if the earnings season does turn out to be more robust than expected, then we might see a rally like we did in the past few quarters. But this will be a more challenging earnings season, and investors will be paying most attention to the outlook that companies are making, even perhaps for next year already.
I mean, the NASDAQ has returned, what, about 32% so far this year. I mean, it's hard to compete with that for any of the other major indexes. What about the value versus growth debate and maybe a revival of some of the Russell plays?
Yeah, I mean, that's the interesting bit here, because value has underperformed so much this year compared to growth, because this rally has been so narrow, because it's mainly been driven by these tech stocks. So now investors, many of them are starting to look towards these value, cheaper sectors and stocks, and especially European market here really stands out, because Europe, unlike the US, does not have that many tech stocks that have outperformed this year. It is very much a value-dominated market. So I've spoken to several fund managers in the past week that are saying that they're now more bullish on Europe because it is undervalued and it does not face as many risks from a potential crash in tech stocks.
Ksenia, fantastic to get your analysis. Thank you very much. That's Ksenia Galauchko there. Let's get to another top story, because China has unveiled restrictions on exporting gallium and germanium, which are used to make chips, electric cars, and telecommunications equipment. The move escalates Beijing's tech trade war with the United States and with Europe. Tech trade in particular is front and center, and to break it all down for us, we're now joined by Bloomberg's Asia government and economy correspondent Rebecca Chung-Wilkins. So it's not so much the availability of the metal globally, it is the fact that China can produce this at a low cost. Just contextualize this for our global audience.
Yeah, absolutely. So these are restrictions or potential restrictions on two different metals. They're not rare metals, as you say, but they're very expensive to produce. And they're really produced actually as a byproduct of refining other commodities. And China essentially accounts for upwards of 80% of the world's use of these two different metals, which are found in everything from semiconductor chips to telecommunications, defense industries, and also for EV. So they have this very wide array of uses. The feeling is really that this is going to in part hurt the European move to try and decarbonize its economy. But longer term, there is also this risk that this kind of policy by Beijing could ultimately backfire by forcing other nations to accelerate this move to diversify and so-called de-risk their supply chains.
I mean, what else would you pull in here? Because there are quite a few news lines. You've got Janet Yellen, who's going to visit China. There's a Wall Street Journal piece on potentially more tensions on the cloud front. What would you highlight?
Absolutely. Well, I think there are these two sort of big elements. On the one hand, we see China showing this new willingness to really combat what it sees as containment by the US. And on the US side, we see no slowdown in this attempt to enforce or roll out these restrictions with this latest report that the US is considering restricting Chinese companies' access to cloud computing services, particularly from Amazon and Microsoft, who are the two that are among the two biggest providers. So, you know, as we see this upcoming Janet Yellen visit to Beijing this week, we really see both Beijing and DC kind of locked into what seems to be an escalation. There is some question that Beijing may have a little bit more leverage now that it's really sort of, you know, supplying a bit more bite with its bark when it comes to pushing back against these efforts to restrict its access to strategic tech. But I'm not sure the sort of outlook is particularly optimistic when it comes for any kind of breakthrough in relations during that Yellen visit.
Rebecca, well done. Excellent reporting. That's Bloomberg's Rebecca Chung-Wilkins there. Let's get you a bit of a snapshot of what else is in the pipeline. Yahoo may make a return to public markets. We'll have more on that next. This is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Markets. I'm Yusuf Gameldine in Dubai. Turning to tech, Yahoo plans to return to public markets. The CEO, Jim Lanzone, told the Financial Times in an interview. According to Lanzone, the company is, quote, ready financially, has a great balance sheet, and is very profitable. Bloomberg's Alex Webb joins us now for more. Alex, this seems like a blast from all the way in the past, but it's still one of the most visited websites, even though it has this, legacy from the 90s.
Yeah, they claim at least to be a top 5 visited website globally. They were, of course, for a long time, for I think 6 years, part of Verizon, the US telecoms giant, which sold it to the private equity firm Apollo for a not insubstantial $5 billion. So it was inevitable that at some stage Apollo was going to try to exit. It seems as though that moment is nigh. It'll be coming in at a not particularly bubbly IPO market, and it's ultimately a media company. Even though it's a website, much of it is about content consumption. So I'm really fascinated to get an eye on their financials when the sort of IPO prospectus comes out, see what's happened while they've been, behind the scenes, in theory, turning things around under the auspices of Apollo, and just how good of a business it now is.
There's a lot happening at Alibaba, and I want to pick that up for a minute because basically they're doing a strategic review of some of the video streaming platforms. Could there be a bit of a cutback, would you say, or perhaps a prioritization?
The thing I'm fascinated about this is, there's talk about them. We've known they're breaking up their business into 6 different units. It now seems the attention has turned to the video operations, UQ and Tubu, and those could be merged into the movie arm, which is publicly traded, but Alibaba controls it. Essentially the studio, which would be kind of similar to Warner Brothers merging with YouTube and Netflix. They would be quite a monster in the Chinese space. How those things all play together, again, a fascinating piece. The founder of Tubu was a Bain consultant, so clearly that's the sort of operation where they get very, very interested in gluing all these slightly disparate but related pieces together.
I mean, the other fascinating development is Facebook is getting ready to unveil its competitor to Twitter. I am willing to give it a go. Is it going to be successful as far as you can tell from what you've heard?
Look, I mean, Facebook is better at running advertising businesses than Twitter is. It is very good at using users' profiles to target ads very precisely. It has also, in the past, been quite good at taking other people's product ideas and bringing them and developing them itself and making a success of them. The main example of that is, of course, Stories on Instagram, which was fairly shamelessly copied from Snapchat. It does have some failures as well. Facebook Paper, no one remembers anymore, was an effort to do a magazine on smartphones, and it died a relatively quick death. So Twitter, more successful product than Paper's analog, which was Flip, I think Flipchart as it was known at the time. Can it really, from a standing start, get to a similar position as Twitter? Possibly. I wouldn't say that it's going to be an absolutely shoe-in success.
Okay. Alex, this has been very helpful. Thank you for making it to the program. That's Bloomberg's Alex Webb. Coming up, we are going to get to Chris Waitling to talk about market strategy. This is Bloomberg.
Of politics.
We're not going to be relying
upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Welcome back to Bloomberg Markets. I'm Yusuf Gameneddin in Dubai. Let's get you another quick check of the markets. Yes, of course, it's the 4th of July. If you're celebrating, congratulations. But the rest of the world is operating. Cash equities and treasuries are closed in the United States. They resumed trading on Wednesday. On the S&P 500 mini, we're called 0.1% lower. A little bit of upside coming through on the stocks, Europe 600. Investors then bracing for the upcoming earnings season. I want to flip the board, get you a bit of a rundown of what else we're looking at in terms of the bond space. We had the Australian RBA opting for a hawkish hold. They held their cash rate at 4.1%. That was predicted by 60% of economists surveyed by Bloomberg. We're seeing yields just come back a little bit, erasing initial gains. And then Eurodollar at 109, flat. Brent crude getting a bit of traction, now in excess of 1.1%. After we had Saudi Arabia and Russia moving to prop up prices by curbing supply. Let's get out to Chris Waitling now. He is the Longview Economics CEO and Chief Market Strategist. Chris, I'm going to get straight to the yield curve inversion, sort of extremities that we haven't seen since the early 1980s. That is a unique superlative for the year. How concerned are you?
Well, I think it's a good illustration that money's very tight. And of course, what we have to remember is that it takes a while for tight money to work its way through the system. But every day we get more and more stories of what's going on in terms of that tight money impacting asset prices in commercial real estate and other types of asset prices. And we can see that bank credit conditions are tight. So, yeah, I mean, it's a pretty strong message. I think the fact it's most inverted since the early 80s is an illustration of how much inflation's out there, and perhaps also an illustration of the central bank over-tightening. So, yeah, I think it's a pretty key metric to watch.
It also helps investors put on a lens or a set of glasses that helps them frame a tone, a narrative for how to approach markets and how to understand the Fed. Let's start with the understanding the Fed for the next 6 months. How does it color that view?
Well, I mean, the Fed have made it quite clear they want to, they're doing their hawkish skip at last meeting, and they want to price in 2 more hikes. They're looking for that kind of expectation. If you look at the dot plots, So there's a couple more hikes coming out of the Fed. And that's consistent with a yield curve that's very inverted. I mean, the most interesting thing about yield curve inversions is when they start steepening. And we saw in March the curve try to steepen. You remember on the banking crisis, 2-year yields came off a lot. The curve steepened up. It moved from 100 points inverted to about 50 in literally a matter of days as the market started to think the banking crisis would deliver a recession. And then, of course, we had the Fed riding to the rescue, providing liquidity. So the steepening of the curve is what we're really interested in, because that's the signal you're about to start moving towards that recession dynamic. I mean, I think over the next 6 months, the Fed's going to continue to tighten, and that's why the curve remains so inverted. But for me, that's not really the interesting story. The interesting story is when it starts to steepen up.
Okay, well, with that in mind, I also want to pull in a view from Goldman Sachs. They're writing that the equity-bond correlations have turned more positive recently, cautioning against dismissing too early the risk of higher rates weighing on equities. That said, less worrying inflation should contribute to more negative equity-bond correlation. We remain underweight bonds. Agree or disagree?
Well, we're overweight bonds because I think the inflation's going to dissipate fast, and I think the drumbeat of recession is still banging. It's just a question of timing. So if you look around the world, quite a lot of the global economy is under quite a lot of pressure already. You know, the UK is not growing as we sit here. Germany's in recession. A lot of the French PMIs yesterday were very weak. Revisions downwards from the middle of the month in June. And you know, you look into Chinese housing. So there's a lot of economic struggles out there, and I think inflation will move fast because it's monetary inflation. It's not a wage price spiral, I don't think. I think we've got a monetary situation here, and money supply is very tight. So I expect monetary inflation to move out of the system quite fast. So we are overweight government bonds, not underweight, and I think, yeah, I mean, we're the other way around. Let's put it that way.
What about the capacity to surprise? Because we had the decision out from the RBA. I mean, quite a few economists expected that. But for the remainder of the G10 central banks and some of the bigger ones, sort of the Fed and the ECB and the Bank of England and maybe the BOJ, over the remainder of the summer, where could we see sort of a real shakeup?
Well, I think the biggest surprise could be inflation surprising to the downside. So, or potentially growth later on this year. So I think those are the key areas to focus on. As I said, I mean, clearly the central banks have a view that inflation is persistent and sticky, and we're getting a bit of a wage price spiral in parts of the world. That's what they're focused on, and they're focused on remaining hawkish, whether it's the Fed's Powell or Lagarde or the Bank of England's Bailey or indeed you mentioned the RBA and so on. So I think the surprise could be actually inflation's not quite as sticky as people think. Just look at commodity prices. Many commodity prices down sharply over the last 6, 9, 12 months, and almost, if not in many instances, back at where they were pre-pandemic or a couple of years ago. So I think inflation could surprise to the downside. That's the thing we're focused on, and that could change central bank rhetoric over the course of the next few months.
There are a lot of investors out there who did not take part in the full rally to the upside, be it in U.S. stocks or some of the other indexes that were able to pull through so far this year. I'm wondering what the message is to clients or potential clients about taking part again now, or has that ship kind of sailed and you would recommend awaiting another drawdown if it happens?
Well, it's fascinating, isn't it? Everyone's getting very excited about AI. They're excited about what happened in 1999, and that maybe we're repeating that in the big cap tech stocks. And there's an excitement that there's a broadening of participation of single stocks in this rally in the last few weeks to some of the cyclical stocks. So clearly there's an excitement out there about these markets. What I would say is, even in 1999, the markets gave back quite significantly a chunk of their gains all the way from July through to October. And we're coming into that tricky summer season now. And I know that July seasonally on average is a good month, but I'm not sure that's the case after a very strong June. So I think a lot of our models are saying we need to pause here, or indeed give back some of these gains. I'd be cautious over the summer. I wouldn't chase it for now. I would watch how the macro plays out over the next 2 or 3 months. I think that's the crux. risk appetite's too high at the moment. I would agree with you, not everyone's been in this rally, but risk appetite's high, and there's been some strong participation in the last few months, and a lot of our market timing models are back on sell. So I wouldn't chase it here. Let's see how the macro evolves over the next month or two.
We also had news out from Russia and Saudi Arabia. I mean, they're both moving to hoover up more barrels out of the market. We have yet to see what the remainder of OPEC Plus is going to do. Is that perhaps one of the risks to your outlook for the remainder of the year? That if they continue to do that, it would support oil prices the upside and push inflation higher, even though you forecast it to come down?
Well, there's a battle on in the oil market, I agree, and sort of 70 and change is a big support level for Brent. And I have to say, I do think the fundamentals are starting to shift, and part of that shift in the fundamentals is what you articulated, the fact that Russia and Saudi are doing voluntary cuts on the supply side. So, yeah, I mean, that could be an issue over the course of the summer. I have to say, though, I suspect there's one more sell-off in oil price, and then you should be thinking about buying oil and energy-related assets. So we're watching that space closely, watching that support level closely. It's going to be fascinating, but I don't think we're quite done on this bear move in oil since post the Ukrainian war.
Chris, this has been terrific. Thank you for sharing some of your latest views. That's Chris Waitling of Longview Economics. Here's what's coming up. We'll stay with that theme and get you more insight on oil as investors assess the latest supply curve announcements out of Saudi Arabia and Russia. Brent crude currently trading higher by about 1.1%. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple of people, our average restaurant now does about over $1 million per restaurant in digital sales.
Can you believe it's summer already? That means it's time for the Boston Pops Fireworks Spectacular. And Bloomberg will make sure you see all the fireworks, music, and special appearances by pop superstars En Vogue, chart-topping country duo Low Cash, and film, TV, and Broadway powerhouse Mandy Gonzalez. Plus the U.S. Army Field Band and the cast of the Broadway musical Ragtime. It all starts tonight at 8 p.m. Eastern right here on Bloomberg Television and Radio.
Welcome back to Bloomberg Markets. I'm Yusuf Ghameddine in Dubai. Oil is climbing after the latest efforts from Saudi Arabia and Russia to prop up prices by curbing supply. Saudi Arabia will prolong its unilateral oil output cut of 1 million barrels a day through August, warning that it may extend even further. And then you have its OPEC plus ally Russia also announced fresh curbs on exports, cutting 500,000 barrels a day over the same period. For more, we're now joined by one of the leading voices in the oil industry, Bloomberg oil strategist Julian Lee. Julian, I mean, OPEC Plus likes to portray itself as a tight-knit family. The fact that Saudi Arabia and Russia pull these kinds of moves hours ahead of a formal announcement on a group level, How stunned are you?
Well, I don't think this is particularly stunning. I mean, we're not expecting any particular group level announcements coming up. There is an OPEC seminar in Vienna the next couple of days, but that's very much a gathering of ministers and industry experts to talk longer term about the energy transition, and I have no doubt about the need for more investment in oil. So it's really a conference. It's not an OPEC meeting in the sense of being a decision-making gathering. So we're not particularly expecting anything from OPEC as a group, and I think that what the Saudis wanted to do was to get this announcement that it's extending its output cut out of the way before this gathering happens, because I think if they hadn't done that, it would have overshadowed what for OPEC at large is supposed to be a sort of, a big family gathering and a very public event. So I think it was understandable that they wanted to get that out of the way. What I think is important is that Russia has joined them very quickly after they made that announcement. And most importantly of all, that Russia has said it will cut oil exports. And that's the thing that they haven't done until now. They've talked about cutting production, but we haven't actually seen any evidence of that in the flows out of the country.
I mean, that's something I want to just flesh out in a bit more detail, because it is all about being able to display transparently that output in Russia is being brought down. What kind of data is the energy world leaning on to really confirm that is actually taking place?
Well, what we're leaning on now is the exports that we can see. I mean, we here in London are tracking the ships carrying Russian oil out of the ports. We have a pretty good handle on the volumes that are being exported by pipeline. We're looking at both crude oil and products exports, and we're really not seeing those having come down since the output cuts were due to come into effect back in March. There's really been no drop in exports since then. Of course, Russia has decided to make its production data effectively a state secret. It's not publishing production data anymore. So we don't have a clear sight of what's coming out of the ground in Russia. There are a number of companies that are the OPEC secondary sources who are trying to assess that production level, but it's very, very opaque. So we have to rely on exports.
Julian, what are you hearing about the trajectory for Brent and WTI as we sort of move closer to Q3, Q4?
Yeah, I mean, everybody's expectation is that the market will tighten significantly in the second half of the year, even without these additional cuts that have now been announced. And that should certainly put a floor under oil prices. I think the expectations for the upside have been eroded somewhat. I mean, the talk of $100 a barrel oil has all but disappeared. The forecasts of Chinese demand growth are getting cut a little bit. The growth there hasn't been as strong as many people had anticipated, despite the opening up of the economy. And I think one of the factors there is that unlike in the Western world, transportation only accounts for about half of China's oil consumption, compared with a much bigger proportion in the West. So opening up after the COVID restrictions doesn't have quite as big an impact in China as it did in either Europe or the US.
Julian, your insights are critical to the energy conversation. Thanks for the chat. That's Bloomberg's oil strategist, Julian Lee there. Here's what's coming up. Part of our exclusive interview with the chairman of France's biggest bank, BNP Paribas. This is Bloomberg.
what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to Bloomberg Markets. I'm Yusuf Gameneddin in Dubai. The chairman of BNP Paribas says France's biggest bank is ready for the rebound. He spoke in an exclusive interview with Bloomberg earlier at the Europlace Forum in Paris.
On market reaction, you know, it's a long debate. We have a long debate about the valuation of stocks, difference between the US and Europe. You know it well. We have a high dividend or reasonably high dividend. We serve well the shareholders. It's up to the market to appreciate the value they want to give, but of course, I would welcome a better appreciation. Now, on the point you have made, which is, what are we going to do? The main trend in BNP Paribas is to support organic growth in a well-diversified business model we have all across the world, notably in global market activities. So you know that we have sold Bank of the West, and we are going to use the money of this operation to support the business, but mainly in an organic way.
Okay, so mainly the focus on that organic growth story. Okay, growth is supported. Jean, can I ask you about Paris as a financial services hub? It does seem that in terms of continental Europe's attempt to build up competition to London, that Paris has done very well at attracting banks to expand. Bank of America, JP Morgan, Goldman Sachs, Citigroup. Is this putting strain on any of the infrastructure? Is this something that we'll see more of?
Well, as a whole, the continent has done well. You have Paris, you have Amsterdam, you have Dublin, you have Frankfurt. All of us, I think, all the financial places in Europe have done well after Brexit. For obvious reasons, clients are on the continent, and it's easier to operate from the continent and to serve the clients in the continent. This is the reason why most of the banks have shifted staff and skills to the continent. And Paris is probably leading this, which is positive from my point of view, for various reasons. It will continue. And you have raised a very important question, which is the quality of financial infrastructure on the continent in the Eurozone. We should never forget that since the decision was made on Brexit, the competitiveness of the continent, the work has been delivered. On the continent, people are working hard to build up better, stronger infrastructure, financial infrastructure. Time is running away, and with this, we see an increased competitiveness. So I know this is a debate, a sensitive debate between the UK and the city and the continent, but you know, people are working hard to improve, and they do, and you see the results.
A timely perspective with the BNP Paribas chairman speaking with Bloomberg earlier on the bank's growth strategy and the future of Paris as a financial hub. Sticking with banks, Bank of America and Citigroup say that the Fed stress tests have got it wrong when it comes to projecting their future income. Bank of America says the Fed's too rosy. Citi says it's too gloomy. It's the latest sign that there's this tension around the central bank's annual exam. Bloomberg's finance editor, Tom Metcalf, joins us now for more. So, Tom, I mean, where are these discrepancies coming in? Where exactly? Is it in the goodwill or is it in the net income?
Yeah, it seems from what we can tell, it's almost on the interest income line or the non-interest income lines as well. But this is the really interesting thing about this story is, you know, these banks are going back to the Fed and trying to work out how they're reaching such different conclusions from effectively running, you know, in their view, the same calculation. And it, I think, goes to show just how, you know, obviously important these tests are. They will play a huge, huge role in how big the payouts are from either of these banks. But also, you know, there is a little bit of a black box around it as well, in that it's sometimes quite hard, at least from the outside, to unpick, you know, immediately what the Fed Reserve is doing. And this is what the banks are then going back to and trying to work out those calculations. So absolutely fascinating wrinkle, something I can't remember seeing certainly very regularly. And, you know, I'm sure we'll be sort of hearing more details about it in the days to come.
The other story I'd like you to weigh in on is Credit Suisse, the most read article on the terminal. This is about a message to get those CVs out of the wardrobe, polish them up and prepare for change.
Yeah, it was absolutely, obviously, huge job cuts expected at Credit Suisse. And what this story says is effectively a lot of the wealth managers have been told, hey, get your CVs out, burnish them, because by the sounds of it, looks like people will be sort of applying for presumably a smaller number of jobs than currently people at the place. So really interesting. Can understand why getting very well read. We obviously know that Credit Suisse is going to, you know, be heavily shrunk by UBS, but this does give a sense that, you know, it's not going to be, you know, unilateral across the board. And frankly, if you're a good performer at Credit Suisse, particularly if you're in the asset management or the wealth management units, then you do appear to stand a fighting chance of keeping your job.
Tom, this has been very helpful. Thank you for reflecting on these developments. That's Bloomberg's Tom Metcalf. We'll see how, of course, some of the bank stocks fare and European trade a little bit later. I mean, of course, the start this morning. Let's get you a snapshot of what else is coming up. Jordan Rochester, Nomura G10 FX strategist, is going to join the debate around what we're seeing in terms of the extremities of the yield curve inversion, but also whether or not we're going to get a meaningful recession and how that affects his approach and his thinking to market dynamics. All eyes on U.S.-China tensions as well. It is July 4th. If you're celebrating, well, good on you. The rest of the world is still operating for the most part, and our coverage continues. This is Bloomberg.
Get a degree in finance.
Go for a career in tech instead. That's the advice from the latest Bloomberg survey of professional and retail investors. Only 1 in 5 Wall Street professionals say high school seniors graduating this year should follow their footsteps and go into finance. About half say that Gen Z's best bet actually lies in the tech sector, and that's despite all those recent layoffs at companies like Meta, Amazon, and Google. Still, hiring trends paint a rosy picture for those with a background in tech. Industries ranging from auto to the federal government have jumped at the chance to recruit any laid-off tech workers. A degree in tech could set you up for a lot of potential jobs and a safety net if any of those jobs don't quite pan out the way that you'd hoped. Survey respondents also expressed concern about the long-term threat of AI. Think ChatGPT taking all of our jobs. For kids graduating from kindergarten this year, about 40% of investors said to go into healthcare. That way, when they come of age, they may be able to hedge against any potential AI-related job takeovers. Roughly 12% said Wall Street would be the right career given that pending AI threat. The AI concerns come despite traders themselves finding that current iterations of ChatGPT struggle with things like math and corporate earnings. But the idea here is that there's still plenty of time for AI to improve and to potentially threaten our jobs along the way.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg.
Good morning. Happy 4th of July. I'm Danny Berger in London. Welcome to Bloomberg Markets. The U.S. markets are closed for Independence Day. Our top stories today. Hawkish pause. The RBA holds rates but warns further tightening may be needed amid continued inflation pressures. Recession risk, a key segment of the U.S. Treasury yield curve, approaches its most inverted level since the early 1980s as traders price in further Fed policy tightening. And the tit-for-tat technology battle between China and the West escalates as China restricts exports of key metals. Let's get a check on your markets. We go without the U.S. today. Volumes are lighter. Last I looked in Europe, they're about 50% less than where we usually are for European equities. Dragging us down, though, is Germany. The data there continues to be troublesome. There's some weather issues, too, when it comes to the Rhine. Now, S&P 500 futures, again, we are off. Hopefully, if you are celebrating the 4th of July, you are not currently looking at the screen. But if you are, it's a basically flat trade in the U.S. Aussie dollar, it did immediately fall in the aftermath of a hawkish pause from the RBA to stronger now. Brent crude finally getting some traction. Russia and the Saudis unilaterally going at it alone, cutting their oil production. Not too much of a reaction yesterday. We're finally higher by 1 1/3%. All right, I want to dive more into the FX moves. Joining us now to do that is Jordan Rochester, G10 FX strategist at Nomura. Jordan, thanks so much for joining.
Good morning, Danny.
The Americans are off, so we can say anything today.
Let's go for it.
All bets are on. Obviously, we got to start with Australia, right? Where the Americans would never go. Look, the Aussie dollar is strengthening, but the immediate reaction was weakening. I just wonder, in a world where the Fed is amping up its hawkish rhetoric, do currencies like the Aussie dollar, the krona, pick your poison, do they risk getting left behind?
They absolutely do. Not because of the Fed, though. It's actually about global growth. So look at the manufacturing data. What does Australia do? They export large amounts of commodities. So when you're building plants, when you're doing the industrial process, you need those commodities. You need Aussie exports. But all the surveys say exports, manufacturing's down. So their key export group is in a tough place. Commodities are on the back burner. So I think for Aussie dollar, the RBA, for example, didn't hike today. We had 4 basis points price. That's why you had that immediate knee-jerk reaction lower. I do think, though, it's very tough for CAD, for likes of Stocky, for likes of Aussie to do well until we have a weak NFP. So look, on Friday, if we get a weak NFP, all bets are off. And you'll have markets thinking maybe the Fed turns dovish more quickly than we think.
I mean, we're not at a place yet, presumably, where some of these central banks need to defend their currencies and be more hawkish just for that precise matter, that they need some strengthening to come through. Are we at that level? What would get us at that level if manufacturing continues at the pace it's at?
Well, in which currency are we talking about? Some banks, they're very close or could consider repeating what they did last year in FX intervention. The Bank of Japan is one of those, where the RBA, that seems very unlikely in terms of their style. A lot of central banks in G10 often say they don't target a specific currency level. So I think in Australia, think about it, what do they need? They need a weaker currency because we're in a manufacturing slowdown. Their terms of trade is lower. They need to help their economy sort of equalize. So in a way, that's part of...
Style often to target a level. The PBOC, I mean, they haven't been targeting a level, right? It's just stopping the pace of weakness we've seen. At what point do you think they will draw a line in the sand? We know it's not 725. Is there a level, will they do that, or will it continue to be the pace for them?
So they probably won't come out and say, this is the level we're going to defend. But we've already seen every single day the daily fixing data. So we had a 300 basis points error, pip, sorry, the other day. This is clearly a sort of quasi-signal, hey, guys, we want to slow down the move. But I don't think that means the move's going to end, because it's a similar story. China's got low inflation, growth is underperforming, and we're seeing kind of lackluster PMI data. So again, from a macro perspective, with low inflation, they have the ability to say, look, we can have a weaker currency to help boost our exports in this time of global slowdown. And then 730 is the sort of target we've got for dollar CNH. We're not too far from it. Today, that's been a bit of a knockback. But as you say, America's on holiday, so don't read too much into one-day moves.
Yeah, fair enough. I mean, while America is on holiday, I mean, just from what you're saying alone, it does seem like the dollar is the least dirty shirt. Is that still true in the second half of 2023, that when we're looking for any sort of economic strength, even though some of the data has been spotty, it continues to be the U.S.?
So what's really interesting about FX is usually, if I have a euro-dollar view, everything else is correlated to that view. This is a really different time for FX. So rates markets say buy the dollar, absolutely, in terms of picking up carry against the euro. We should be at 105, but the equity market's rallying. And this is like fixed income investors having a very tough time. To be a good fixed income investor, sometimes you have to control your bearish urgencies, your sort of predisposition that way, because bonds rally when it's risk off. And with equity markets rallying, it's saying sell the dollar. So you have to pick high carry currencies and where you think actually there's going to be some sort of move in a hawkish direction by the central bank over the Fed. Where I think in Q4 of this year, what will change, Danny, is that we'll have very weak inflation in the US compared to what we've been used to for the past 6 months. And the labor markets might start to crack. I think NFP this week isn't going to do that. But we've got signs from the surveys that actually labor markets will slow down by Q4. We might even get zeros on NFP. And that might be enough to say the Fed's done. And the market will happily price in rate cuts for next year.
It's taking so long to get to that point, though, to get where the labor market cracks, to get where the data slows down. Have you been surprised about the resilience we've seen?
It's been a bit of a widowmaker of a trade.
Yes.
So in terms of rates. So in one way, I'm glad I mostly trade FX. Right. It's been a bit easier in that respect. It's all about lags. So I think the excess savings story has made all of the charts really difficult to read. So PMIs, ISMs, they went to -2 standard deviations. They went up to 2 standard deviations. Now they're down to -1. These are charts that usually say it's as bad as Lehman Brothers. And you can't take that at face value. So the surveys that guide us through this process are a little bit all over the shop because of a pandemic. It really makes things change quite quickly. But I do think they all point to one thing, which is US inflation is going to go back towards 2%, even potentially 0 if energy markets are any guide. So that sort of narrative makes the second half this year clear to me that we should see euro break above this boring range it's been in, and we'll have dollar weakness against the euro.
Well, one argument I've heard of why the euro can't break out of its range is because the Europe, considering the economic data, is less likely to stick with higher for longer, that they'll be the first to crack. They'll crack before the Fed, or they won't get to where they're guiding the markets. Do you give any credence to that argument?
I don't, for a few reasons. One, Europe is 20 currencies in the euro area, so it depends which one you're looking at in terms of the cycle. But the ECB they've started hiking after the Fed. They've been hiking more slowly than the Fed. And they're looking at the most lagged variable, which is wage data, as their guide. So the ECB was quite stubbornly on hold for so long, pointing to negotiated wages being weak, saying, look, inflation's going to be transitory, we don't need to hike because wages are weak. It's going to be the same the other way around. So when inflation's falling and looking quite weak and the market might be pushing them to consider rate cuts next year, they'll be pointing to the wage data, which is really strong right now. It's at some of the series, it's the highest they've ever been since the creation of the euro. Because they're using that lagged variable to help guide their process, I think at most they'll just be on hold.
I mean, the bond market at least is not pricing that. It's pricing in cuts from the Fed. It's not really doing that from Europe. I mean, why are we slow to come around to this narrative then? I mean, I completely get what you're saying, but the market isn't heading that direction.
What's been the big surprise, really, and something that we've never dealt with in modern history, is this level of excess savings. So we have to really look at which countries have the highest and which have the lowest. The UK has a high amount of excess savings. That's why the services inflation just keeps surprising us, even though all the models we have suggest that inflation should be much lower on the services sector. For the past 6 months, it should be lower, yet it's been printing new highs. Part of that is the second round effects, but also because of the excess savings. Well, look at Sweden. They didn't lock down as aggressively as anyone else. They were famous for that. They also didn't have the same level of fiscal spending as everyone else because they didn't lock down. And that led to very little excess savings. So we're seeing the charts work in countries like Sweden. And that's why we think Eurostocky could go above 12 towards 12.30.
Yeah, that's a really good point. We often lose sight of that weirdness. That was 2020. Hey, Jordan, before we let you go, just want to end it on sterling, because while we're talking about the second half, best performing G10 currency versus the dollar, what does the second half hold?
This is the hard part. I think the market is pre-positioned because of Brexit to be very bearish on sterling. I personally think that euro sterling should be higher towards 88, towards 90. However, that service inflation has made the Bank of England pricing extremely high, so over 100 basis points by the end of the year. And until we get some signs that inflation is topping out in the UK, especially on the services sector, that's going to be a widowmaker of a trade to be short sterling. But I'm waiting for that moment. Let's see at the next CPI release. If service inflation goes down, a lot of people will jump on that.
Jordan, too many widowmaker trades. I can't
keep up.
One. It's too much. Jordan, thank you so much for joining. Really appreciate your time. Nomura's Jordan Rochester there. All right, sticking with the market calls. Allianz expects the global economy to stage a timid recovery from mid-2024, and says the equity markets are heading towards challenges after a strong first half. Allianz's chief economist spoke to Bloomberg at the Europlace conference in Paris about his expectations for soft landing.
It depends vividly on central banks' determination to kill inflation, you know? I mean, what is fascinating today is one of the main risks to the economy is the risk of policy mistakes from central banks, and this toxic policy mix risk between fiscal and monetary tightening at the same time. So behind our soft landing, even though I don't find any landing to be soft in history, there is this assumption that, you know, policymakers do the right thing at the right time. So maybe don't, pull the plug too strongly, too fast on the support mechanisms, especially in the US and Europe, of course.
Well, but I'm interested in what defines a policy mistake from a central bank, Ludovic. If we end up in recession, but it can be justified by the fight against inflation, does that equal a policy mistake, do you think?
Look, last week I was in Sintra for the ECB forum, and the President Lagarde actually mentioned that she's going to be looking at some of the pass-through, some of the transmission uncertainties and so forth. But for me, what would be a policy mistake would be the decision to wait for the full pass-through, meaning this data dependence, obsession that central banks have, could yield to a moment where we decide to pivot when it's already too late, which means the embedded tightening from central bank to the real economy is already visible. And for me, this is already too late. So that's a policy mistake. And this is a little bit the discussion that happened last week in Sintra, which is what would happen if the ECB were to hold rates high on top of adding a couple more hikes for the full of 24 to see the full transmission. This, for me, would qualify for a policy mistake, because that would mean we would start seeing the real economy effect of this embedded tightening. And so that would be already too late for the central bank to pivot.
Ahead of 2024, though, I assume, Ludovic, when do we get to a position where the ECB can hold and does not need to be hiking anymore? Of course, we've seen this pause, or maybe it's a skip at the Fed already.
It's interesting. I think what came up a lot last week was this wage price spiral risk, which seems to be quite the question that everybody has in mind in Europe, because we've seen some inflation in the services sector, and we also know that some countries in Europe have some form of indexation, or maybe a public sector wage bill that is very strong, and that leads to some form of additional, upside risks, I would say, on the wage bill. You also see what's happening a bit on the social risk in a lot of countries. So I think the risk now is to say, okay, maybe they will hike till they see that wage inflation and especially services inflation is under control, that could be, let's say, in the fall. So I would say a couple more hikes, and then they hold still as of Q3 or maybe beginning of Q4 this year.
Ludovic Chabran there, the chief economist of Allianz, speaking to Bloomberg earlier in Paris. Now, it might be closed. It might be a closed market in the U.S. for stocks and bonds, but that doesn't mean it's not interesting where we left off yesterday and what that means for today. The yield curve inverted even further in the U.S. It's not just America's birthday. It's the yield curve's birthday, too. 1 year since it inverted and stayed there. So that's the risk appetite picture looking into today. Now, European stocks are doing pretty well considerably, but some of the more high beta type stocks aren't doing as well. We're looking at a flat future session. Aussie dollar, now we're just talking to Jordan Rochester about this. He says, look, currency is like the Aussie. They're not going to be left out because of rate hikes, because of rate differentials. It's going to be because of the growth picture. Now, here's Brent over the past 2 days. This is an interesting one. All right, bottom of the screen, Brent, that's just today. You can see up 1 1/3%. This is off the back of both Saudi and Russia announcing that they would extend their unilateral cuts, their oil cuts, into next month. Now, this is interesting because we haven't seen as much pickup with these moves. The fundamentals, some argue, are not what's dictating this market. Perhaps it's the bearish view on growth. So we continue to have these types of cuts in hope that finally oil prices will pick up. Remember, the U.S. is also filling their SPR. All right, coming up, the tit-for-tat technology battle between China and the West escalates. China now restricting exports of key metals. This is Bloomberg.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
My view is you end up with growth disappointing a bit and inflation disappointing on the high side a bit, ending up, probably bad for bonds and probably, a little bit bad for equities and generally weak growth.
Bridgewater's Greg Jensen there speaking on the Bloomberg podcast Odd Lots. Let's get more into this market dynamic. Joining us is Bloomberg's Ksenia Galushko. Ksenia, this continues to be the most hated rally, right, in equities. Everybody loves to rail against it, saying the first half has been too strong. You flagged a really interesting note from Citi. That's not necessarily what the positioning is saying.
Well, the position is actually getting quite stretched in the S&P 500 futures. And yes, it is not as stretched as it was a couple of weeks ago, but it is still posing a risk to this rally. So there might be a short-term profit taking. And I think as we head into the earnings season, as the tech rally is getting more and more frothy, we might see some profit taking just because of how great the returns in the first half of the year were, and investors might want to take profit at this point in time.
I was going to say, I'm presuming this is mostly concentrated in tech, where this overstretchness is.
Well, that's right. And that is the main cause of concern, because this rally has been so concentrated. In order for it to really become one of those real rallies and for the whole year to bring double-digit returns, the rally needs to really spread to those other sectors like cyclicals, like value, like defensive sectors. So many investors now are really getting concerned about those overvalued tech stocks that have been driven by this buzz around AI. And now, yes, most agree that AI will drive lots of profit growth over the next decade, that it is really a huge turning point. But at the same time, the rally might have gone just too far, because the NASDAQ currently, the P ratio is about 40% over the long-term average. So it is at very expensive levels. And I was looking at the relative strength index today, and that is also now heading towards overbought territory once again.
Ksenia, one of my favorite quotes of this week is from your excellent piece over the weekend. I know you spoke to Andrew McCaffrey at Fidelity Investment, who said, resilience now is sowing the seeds for fragility down the line. I really love that. How much of this is also about the economic picture? Again, not just the technicals, but fear over where not just American, but also European economies are going.
Absolutely. So the second half of the year is going to be very difficult in terms of the economic data. I mean, we've been seeing resilience in general in U.S. data, like consumer confidence and new home sales. But at the same time, manufacturing came in quite weak, both in Europe and the U.S. yesterday, and that is posing concerns. And now this recession risk is getting pushed back. Obviously, we keep waiting for it to come. It's the most expected recession of all times, it seems. But it will hit at some point, according to most strategists, be it at the end of this year or early next year. So investors are going to be preparing for that, and they will not want to miss out on these double-digit returns. So at some point, in order to post really good returns for this year, it will just be safer for them to take profit and exit.
Yeah, the FOMO turns into the fear of, I don't know, getting stuck, the fear of having losses. It's not good, Ksenia. I'll work on that. What about earnings? What are strategists saying about the earnings risk if the economy is starting to deteriorate?
So this earnings season that we're going to see in July might be the last positive earnings season in a while. The previous earnings seasons came in more robust than expected, and they continued driving the rally since October in equities. Now this one, we're already starting to see strong warning signals from the chemical sector, from FedEx, from Siemens. I mean, we're going to see some more warnings, and investors will especially be looking out for these forward-looking guidances. Another concern from this earnings season is that with inflation coming down in the U.S., companies won't be able to pass on this price growth as much as they were able to do that last year. So last year, earnings really surprised investors in that sense, that companies were able to pass through those higher costs to consumers who were still had enough savings to keep spending. But now this picture is going to be more complicated.
Yeah, I think that's a really good point. It's also a good point you bring up those chemical companies, because chemicals, I mean, they're in kind of everything. And that was a European company. So how do you look at the divide, or how have folks been looking at the divide between Europe and the U.S.? Because there was that whole narrative, okay, if the U.S. is frothy, maybe diversify away, maybe go to Europe. Is that still part of the conversation?
Well, yes. So I'm hearing more and more of investors being neutral or overweight Europe and underweight U.S. just because of how much the tech rally has gone ahead. Now, in Europe, the other problem is that it's very actually dependent on China growth. And China recovery has been quite tepid. Their monetary stimulus is not very strong as it was expected to be. So this weakness in China is actually going to be quite risky for the European rally because of those luxury stocks that are super dependent on those China sales. But at the same time, Europe is much cheaper than the US. The rally there has not been as strong just because it doesn't have as many growth and tech stocks as the US does. So I'm hearing more and more that Europe actually might be a better opportunity if the tech rally does come to a halt and starts selling off. Europe is the safer place to be in that situation.
Yeah, a good place to get cyclicals. Ksenia, thank you so much for joining. Ksenia Galuchko there from our Bloomberg Market. Markets team. Now, Ksenia was just mentioning China. Let's look at another angle of this and the escalating tech battle between China and the West. So we had China unveiling restrictions on exports gallium and germanium. And if you don't know what those are, that is fine. I don't either, but I do know that they are used to make chips, electric cars, and telecommunications equipment. Joining us now, let's get over to Bloomberg's Liesl Hill, who leads our coverage on mining and metals. Liesl, so I mentioned part of what these things do. I know you know them better than me. So explain how big of a deal this is to restrict these exports.
Yeah, so these are, you're not the only one who hasn't heard of them. I certainly hadn't thought about them for a good little while. Basically, these are they're what we call minor metals, which means they're metals that aren't typically found on their own in nature, in ore bodies or anything like that. They're found with other more familiar commodities like zinc or aluminium. And they're pretty expensive to produce as well. So as a result, basically what's happened is China has become the most significant and dominant producer of these two minor metals. I think China produces something like 94% of gallium, in the 80s of germanium. And because China's so dominant, and we've seen other companies, just not having the incentive to extract them alongside their zinc or their aluminium, production elsewhere has decreased quite dramatically. And they are very, they're quite specialist. They're not in everything. They're not by no means as important as something like silicon in chips, but
like also AI, for example. Would NVIDIA, for example, be using these kinds of materials in some of what they're making? How tight are those?
Not my specialist, but yes.
Okay, fair enough.
Very, very, very possibly.
Okay, okay.
But yeah, chips, they're used to, as I said, they're used to light up your cell phone. They're used in satellites.
So we are using it every day,
systems,
more or less.
Yep, absolutely everywhere.
So where else then are mining these types of metals? Could this possibly change the supply chain, or are we just extremely reliant on China for it?
Yeah, so at the moment, yes, very much reliant. But as I said, they're not particularly rare. They are found all over the place. The question is just whether or not you've got the facilities to extract them. And so we do have other countries, Japan and South Korea, Russia and Ukraine are places where gallium is produced. And then germanium, there's some production in North America, in the US and China. We also get from Belgium as well. So the question obviously is whether these other companies and additional producers would, if prices rather rise as a result of this move, if we see other people wanting to get on the bandwagon and increase production. But so the one kind of comparison that we do draw is to rare earth metals, which we've all been talking about in recent years, where China's kind of given everyone a bit of a shock. Another place where China dominates production and other kind of strategic critical minerals. And so when China, around 2010, briefly shut off supplies to Japan, the rest of the world went, whoa, whoa, whoa. All of a sudden, we realized how significant these are, how we're kind of, at China's beck and call. And so other producers went to go and try and expand production, and we have. And so that's probably what will happen with these ones. But the fact of the matter is it takes time. There's kind of specialized processes. They're very high purity metals in the way that they're used. And there's all kinds of, sort of procedures that need to go through in getting these new products tested, accredited for suppliers. Obviously, these are high-tech things, so the customers need to make sure that they know what they're getting.
Yeah, so it's not just simple as
you can't just switch it on.
Yeah. Liesl, thank you so much for joining. Really fascinating. Now I feel like I know, maybe not everything, but much more. Liesl Hill there from our Bloomberg Metals team. Now, still ahead, Jennifer McGowan. We're going to be having a conversation about this economy because she, of course, is the chief global economist at Capital Economics. We're going to talk about the globe. We'll talk about the UK. Plenty to discuss on this 4th of July. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Welcome back to Bloomberg Markets. I'm Danny Berger in London. We go without the U.S. today. It is, of course, the 4th of July. Happy Independence Day, everybody. So volumes are certainly lighter. We do have, of course, Europe up in trading, cash markets up about 0.1%. We're off the highs of the session. The DAX is underperforming. The IBEX is underperforming too. Maybe some more of those cyclical type sectors weighing down. S&P 500 futures, the future session still trading. We're basically flat at this moment after that rally in the first half continued into the second half. Aussie dollar, that gets a bid this morning. The RBA did indeed hold. There was only about 4 basis points priced in terms of a hike, so it wasn't a surprise, but we did have that gut punch reaction of moving lower. It has rebounded. As they said, they might need to hike even more. Finally, Brent crude finally getting a bid after both Saudi and Russia decided to keep those oil cuts going. That is a unilateral decision ahead of an OPEC symposium. We'll see how that plays with the rest of the cartel. All right, let's stay on the central bank story, and we did have some more speak from the ECB. Governing Council member Joachim Nagel said there's still some way to go in the bank's hiking campaign as, quote, upside risks to the price outlook dominate. Joining us to discuss is Jennifer McCowan, Chief Global Economist at Capital Economics. Jennifer, really wonderful to speak with you today. Look, the euro has failed to break out of its range at this point, so maybe FX markets doubting a little bit the continuation of higher for longer in Europe. But you think rates are going to be staying higher for longer in Europe, more so than the U.S. Why?
Yeah, I think that probably is right. And that tone that we've seen from Nagel is really consistent with what we heard from Lagarde at Sintra, at the Sintra conference last week. So I'm not that surprised that it hasn't moved markets significantly. But it's clear that the tone from the ECB is a pretty hawkish one, and that the Governing Council is really concerned about the strength of price pressures. In contrast to the US, what we're seeing is that services inflation, even if we measure it on a month-on-month basis, is just persistently strong. It's persistently high. There's really no evidence of it coming off at the moment. And there's a real concern in the Eurozone that the relative stickiness of wage bargaining there is going to mean that wages are stickier, that wage growth stays higher for longer. And there's really no sign of labour markets loosening, or little evidence of labour markets loosening in the Eurozone. Employment intentions in the latest PMI surveys, for example, still very strong.
It is interesting because if we think back to when we ditched the word transitory, still a lot of the conversation in Europe was, okay, this is energy driven, it's high energy prices. Can we just fairly say now, Jennifer, can we just put a line under it and say, okay, this is much more demand driven than we had originally thought?
Yeah, I think we can, but I think really it's about the passage of time. And at Sintra last week, Lagarde set out 3 different stages of inflation, which have progressed initially from just energy prices, energy inflation now 0 or even lower. So that's not really an issue at this point, although the level of energy prices is still an issue. It's not pushing up inflation anymore. So now it's spread to supply shortages and the impact that was having, but now more and more more it's about domestic price pressures. And that's a real concern because that's likely to be more sustained. So this tightness in labour markets, the strength of wage growth, that's really what's worrying the ECB at this point, and the potential for that to have knock-on effects on inflation expectations.
Given the continued strength of the labor market we've seen, is there also a sense that the transmission mechanisms, not that they're different, but the impact of them is perhaps lessened than we've seen historically?
Yeah, transmission mechanisms are so uncertain at the moment because it's been so long since we've had a tightening cycle, and for the ECB, which is relatively new, this tightening cycle is pretty much unprecedented. So it's so hard to judge just how it is going to feed through to the economy and how long that is going to take. I think the concern at the moment, we can judge what's happening to market interest rates. We can see that policy is feeding through to market interest rates. That will then take some time to take effect on household costs, on mortgages in particular, given that a lot of mortgages in the Eurozone are still at fixed rates. But it's also taking time to feed its way through to inflation expectations. I think because we've had a succession of inflation shocks around COVID, around energy prices, around the Ukraine war, that the longer that persists, the more of those shocks there are, the more people start to build that into their inflation expectations and to the inflation psyche across the economy. So the concern is that there's been kind of a shift in a lot of the trade-offs in the economy that could just mean persistently higher inflation.
You mentioned some of the differences between the U.S. and Europe, Jennifer. When it comes to the U.S., we had that ISM data, manufacturing data yesterday, weakest since May 2020. How much confusion is there in this data? How do you read past what is potentially noise when you get data of strong housing, employment still strong, consumer confidence, and then something like this, something like manufacturing at a 3-year low?
Yeah, there's a big contrast at the moment across the advanced economies, actually, in what's happening in manufacturing and what's happening in the services sector. So we know that manufacturing output was really affected by supply shortages around COVID, by factory shutdowns. We then had this rebound, and now we're seeing kind of the payoff from that. Things are weakening again now that we're no longer in this environment of large backlogs that need to be worked off. And so it's understandable that manufacturing output is weakening alongside global demand. But for the services sector, it's a different story, really. You're still seeing a great deal of resilience. Consumers, households still seem to have some savings or have had savings that they've been spending because of the fiscal support that you've seen across the advanced economies. And that's meant that the services sector is still relatively resilient, and it's feeding into these persistent price pressures.
That is so interesting. It's almost two things happening at once. You have the bullwhip of the COVID effect on the manufacturing finally starting to unwind, and then you also have demand destruction from central banks. How are you thinking about that dynamic specifically in the UK, Jennifer, when it comes to finally getting demand destruction that can bring inflation back down to earth?
Yeah, well, we think that will happen. UK interest rates have risen a very long way, and it has to be that starts to take effect on the economy. So far, the UK economy has been surprisingly resilient. There had been widespread expectations that it would be firmly in recession by now, and that hasn't really happened. But we think that probably, given that a lot of mortgages in the UK have shifted from previously being very variable, a bit more like the situation in Spain, to being more on fixed interest rates, so edging towards the US norm, albeit not quite as long fixes as you typically have in the US. That means that the transmission is a bit slower in the UK than it used to be. So it's taking longer for this monetary tightening to actually affect households. But now mortgage rates have risen above 6% in the UK. That's bound to start to bite. More and more people are having to refinance at higher rates. It is clear that that's having an impact on the housing markets. I think it's going to increasingly have an impact on people's ability to spend. Our calculations suggest that probably around 60% of the effect of previous interest rate hikes in the UK has yet to come through. So ignoring what's yet to come in terms of the policy rate, there's still a lot of pain to come from the rate hikes that we have already seen, and we think that's going to push the UK into a recession quite soon.
Jennifer, I just want to tap into your, and quickly hear your experience and your knowledge of the Bank of England. We had Megan Green in a piece in the FT, sounding a bit more hawkish, higher for longer. She's comfortable with that. What does that do to shift the dynamic at the BOE if she's replacing essentially one of the most dovish MPC members?
Yeah, it could mean a bit of a shift in the dynamic for sure. I mean, she's. We don't quite know how she's going to behave as an MPC member. We know a lot about Megan Green from comments that she's made across social media and in newspapers, and she does seem to be more on the hawkish side. So we'll see how that influences her policy making. But of course, her views on the neutral rate of interest and the long run rate of interest might not be the same as those on where rates should be right now and what the appropriate rate is for the economy at the moment. So I think it does seem pretty clear that there's there's a supply-demand imbalance in the UK, that particularly given the shortages of labour that we've seen as a result of the reduction in labour supply, that's pushing up wage growth and does mean that interest rates probably need to be set significantly higher than that neutral rate for some time. So I suspect that she'll be on board with the message that we heard from Andrew Bailey last week, that there is a bit further to go for UK interest rates, and perhaps more importantly that they need to stay at higher rates for a while after we reach the peak.
Jennifer, so wonderful to get your thoughts today. Please enjoy the rest of your week. Jennifer McGowan there of Capital Economics. All right, let's turn now to oil. It's climbing more than 1% after the latest efforts from Saudi Arabia and Russia to prop up prices by curbing supply. Saudi Arabia will prolong its unilateral oil output, definitely not cut of 1 million barrels a day through August, warning it may extend even further. Its OPEC Plus ally, Russia, also announced fresh curb on exports, cutting 500,000 barrels a day over the same period. For more, we're joined now by Bloomberg oil strategist Julian Lee. Julian, I first want to start with the timing of this announcement, because we're going to be getting an OPEC symposium, I believe they're calling it shortly. We're also looking at the U.S. refilling their SPR. Just what do you make of the timing of this announcement?
I think the timing is understandable. I think OPEC has this big conference coming up in the next couple of days. This is a very public event. It's a showcase for the organization, for oil ministers, for their view of the energy transition and the need for more investment in oil, both of which I think we'll hear a lot about. And I think it's quite understandable that Saudi Arabia, which had implemented a unilateral output cut for July and had already hinted that it might extend it, I think it makes sense for it to get that announcement out of the way, because if it hadn't, I think that would have overshadowed this event and taken all of the oxygen away from the much broader discussions that they want to have in a very public setting. So I think the timing is understandable.
What about from the U.S. side of things? Again, if this is when they're trying to fill SPR and they're looking at Saudi and Russia having an influence on prices.
Yeah, I mean, I think that the refilling of the SPR, to whatever extent various U.S. administrations going forward decide it's necessary, this is a long-term thing. I mean, this isn't, something that's going to be done in the next 6 weeks or even the next 6 months. So I think there are different timescales at play here. What is interesting, of course, is that this announcement was made the day before Independence Day, when, although not a holiday yesterday in the US, it was still a pretty quiet day.
Right.
But I think they